The Bitcoin Standard Podcast brings you seminars from Saifedean.com, my independent online learning platform where you can take my online courses on the economics of Bitcoin and economics in the Austrian school tradition, join our 2 live weekly seminars, and read my books before they are published. Sign up now for access to the draft of my forthcoming economics textbook, Principles of Economics, and take 5 full online courses based on my books, The Bitcoin Standard, The Fiat Standard, and Principles of Economics. The Bitcoin Standard Podcast is brought to you by Crowd Health. Crowd Health is the Bitcoiner's answer to fiat health insurance. If you listen to this show, you've probably heard me rail against the problems of modern healthcare and health insurance. Crowd Health is a brilliant new solution to this problem that leverages the power of Bitcoin to help people get affordable healthcare. Crowd Health holds its cash reserves in Bitcoin. It negotiates with healthcare providers on your behalf and gets you much better rates by offering to pay them cash, upfront, without having to go through the expensive bureaucracy of modern healthcare insurance. It's a solution that works better for healthcare providers and for patients by disintermediating large insurance companies who have the wrong incentives and are constantly raising costs. I'm very happy to have signed up for Crowd Health, and I'm really excited to support them as they disrupt the fiat health insurance industry. Go to joincrowdhealth.com and use the discount code SAIF, S-A-I-F, and you'll get the first 6 months for $99 only.
Coinbits. Coinbits is a great way to introduce your pre-coiner friends and family to Bitcoin. Get them set up in under a minute and help kickstart their journey by turning everyday spare change into Bitcoin. This Bitcoin-only app takes the uncertainty and fear out of Bitcoin saving by rounding up debit and credit card purchases to the nearest dollar, then using the difference to buy Bitcoin. Set it, forget it, and let the app automatically tax your high-time preference spending by saving the hardest money ever. Want to save in Bitcoin faster? Customers can multiply their roundups up to 10x or adjust their savings frequency for weekly or daily Bitcoin stacking. Coinbits is built on a sound, tried and true dollar cost averaging strategy that turns Bitcoin's volatility in your favor. Once you've gotten a private wallet set up, Coinbits encourages you to withdraw your Bitcoin to your own private wallet and embrace the Bitcoin standard way of life. Start stacking on coinbitsapp.com and save your time and energy in the soundest money ever.
Get paid in Bitcoin regardless of who you work for and regardless of who is paying you. All thanks to a premium service I personally love and use, and that is Bitwage. Thanks to Bitwage, I receive my book's royalties in Bitcoin. It is cheaper, faster, and easier. It is a true set it and forget it system, and Bitwage has been offering this premium service since 2014. Anyone can sign up and use it right away. No restrictions or limits, fully non-custodial. You can even split your incoming payment. Get part in Bitcoin and part to a bank account you specify. It could not be easier, and I cannot recommend Bitwage highly enough. Go to bitwage.com and sign up now and get paid in Bitcoin with your next payment or salary.
Hello, welcome to another episode of the Bitcoin Standard Podcast. Our guest today is Dylan Leclair. Dylan is head of research at Bitcoin Magazine, and he is a senior analyst at UTXO Management and the co-founder of 21stcenturyparadigm.com. Dylan has made quite a name for himself over the last few months by being one of the earliest people who warned about the collapse of several Ponzis that have come as a big shock for most people in the crypto industry, or whatever remains of the crypto industry at this point. And Dylan early on has been warning about all of these things, particularly yield products, explaining the risks, explaining why the benefits don't outweigh the risks as compared to holding your own coins. So I wanted to host Dylan to talk about these important lessons that we learned from this, talk about what drove him publicly and very early warn about those things, what are the signs, and then also to discuss his views on the broader macro environment, because he has similarly controversial views about other kinds of yield products that fiat market participants will think of as being very different from the yield products in the crypto world. But I think Dylan and I will probably disagree with that. So Dylan, thank you so much for joining us.
Safe. It's an honor to be here. It's quite awesome for me. It's surreal a little bit to come full circle to be on this podcast talking to you. We've met a couple of times throughout some various conferences, but can't lie. I mean, I picked up your book in high school, and it was one of those kind of aha moments that led me on this path. So it's quite an honor, and I'm excited for this.
Well, very, very happy to have you as well. I've been quite a fan of yours over the last year, watching your Twitter just explode with incredible insight. So I hope this lives up to it.
Let's dig in.
All right. So first of all, let's begin with the start. I think the beginning was the collapse of Luna. And we're going to be posting in the show notes. There's going to be links to all of the threads that you made about these collapses and why each one of them fell apart. So first of all, what drove you to suspect that things were fishy in the Luna situation?
Yeah, so just being transparent, I didn't dig into Luna as early enough as I should have. Had no Luna or altcoin or UST exposure myself, so I didn't really feel the need for it. They announced that, and I guess I like to follow crypto adjacent assets or quote unquote networks just to kind of understand the dynamics. The reality is that this entire industry or quote unquote asset class is cross collateralized for better or worse. Bitcoin also has its own kind of native speculative nature to it in the upcycle. There's no denying that, and its own kind of leverage and recklessness. But particularly this cycle and cycles previously, like the 2017 ICO boom, there's all sorts of perpetual motion machines, Ponzis, bubbles, and that has an effect on the Bitcoin exchange rate. So I was just, for a little bit, like kind of fascinated about how these things work. And I started to dig into Luna and UST and what that ecosystem, if you want to call it, was building, particularly when they started to announce that Do Kwon was parading around podcasts saying, we want to be the second largest holder of Bitcoin in the world behind Satoshi. So, I mean, never mind anything else, that just grabs your attention. So it was, how are they buying this Bitcoin? Well, they're buying it with UST. Okay, well, how did they get the UST? And they basically, had a Luna pre-mine and then swapped the Luna. They said they didn't print it out of thin air, but they swapped it with the ICO tokens they gave themselves. So that was okay. They want to dump. It makes logical sense. They want to dump their pre-mined shitcoin for Bitcoin. Like I would, probably do the same. But the premise was that they're backing their algorithmic stablecoin with Bitcoin reserves. And so, okay, that's an interesting idea, but how does that hold up? And the reality is they're backing that algorithmic stablecoin. Whenever it goes below that 98 cents lower bound, Luna basically prints and dilutes to maintain that peg of UST, because you can always swap $1 of UST for $1 of Luna. So I really, when the peg started to falter just a little bit, I really dug into these mechanics and realized once the peg broke and once the Bitcoin was dumped, but even before the Bitcoin, once the peg was broke, Luna was algorithmically diluting towards zero. Like it was just hyperinflating. The whole thing was hyperinflating. And that's, that is what it is. And altcoins going to zero. Most of these things trend towards zero, but never actually, exponentially decay towards zero in a matter of days, matter of hours rather. But the big thing for me, talking to some people in the know and just kind of, analyzing history of financial crises, it was, well, this is a real big story of balance sheet impairment. This is, you had $18 billion of UST that people thought were stable coins that evaporated in thin air. And so from a, crypto native perspective, that was, I didn't know whether it was Three Arrows or Genesis. Like I didn't have an insight into whose balance sheet was going to get impaired, but I knew that there was plenty of balance sheet impairment out there. So basically a day after the Luna UST Ponzi collapsed, I was kind of trying to scream from the rooftop, get your coins off of yield farms, yield products, because who knows how many dead bodies are out there. And here we are 6 months later, and the dead bodies are everyone. But that was the start.
Yeah. So let's dig in a little bit into how the mechanics of this work. So I'll confess, I in about 2015, 2016, I spent quite a bit of time studying the early generation of shitcoins, things like Ethereum, Ripple, Steam. I've said, but probably most listeners don't even remember it at this point. I looked into these, I dug in, I read the white papers, my eyes started bleeding. Lost many points of IQ, which I may never recover. But then after that, I just decided, the bar for me to look into an altcoin and read it is going to be basically, it's got to have to flip in the US dollar for me to pay attention. Like even if they flip in Bitcoin, that's not really going to get me to want to read the white paper, because I've seen all the dynamics. It's pre-mined, all of those things. So I wouldn't even pay attention to it. So I with Luna, I did not pay any attention to it as it was happening. And even when people were saying, well, they're buying Bitcoin, still wasn't enough for me to dig out the white paper. So, and then I saw that it imploded. I looked into it a little bit more, but I still, I still don't consider myself an expert in this one particular shitcoin. So, how did it exactly work? So they pre-mined their token. They made this new thing called Luna, which is a new token.
Yep.
And they made it out of thin air, basically.
Yep.
And then how was it generated? So they pre-mined, they made obviously a first batch for the people behind it, the usual shitcoin standard operating procedure. And then how does the mining of the rest of the tokens come along?
Safe to be honest, I mean, I was just looking at the UST anchor mechanism and how that peg was redeemed. In terms of the Luna mechanics, the supply issuance, I mean, I never once looked into Luna as an investable asset. So to be honest, I'm not even really sure. All I know is that UST, as it relates to the Luna protocol, as an algorithmic stablecoin, as long as the Luna to UST collateral, or the Luna to UST market cap ratio was sufficient, was high enough to where, as UST broke, you could always, the mechanism was you could always take $1 of UST and redeem it for $1 of Luna. But the problem was that once the Luna market cap started to crash and the UST market cap was so bloated that once you had a scenario where, say, there was $20 billion of USD stablecoins and $18 billion of Luna, you were in a doom loop, basically a perpetual spiral towards zero. Because if you, as a stablecoin holder, want to redeem, it's just a protocol swap. This is like supposedly algorithmic for $1 of Luna from your dollar stablecoin holdings, quote unquote stablecoin. Well, the way that the protocol or the mechanism gives you that dollar in Luna is by printing more into supply. It's not taking it from anybody. It's printing more into supply. So that works when the market cap of Luna is really, really high relative to UST. The reason that UST got so high, so big, was because they had this anchor protocol, which they were subsidizing. So with the pre-mined tokens, they were subsidizing this 20% yield that everyone thought was free lunch. So the 3 Arrows of the world and the Celsius of the world, right? If you go back to the crypto native yields of 2020 and 2021, well, you had the GBTC arbitrage, right? Closed end trust. You put money in, it's trading at a premium. It locks up for 6 months, and then you can dump those shares that you got. You can hedge that market neutral, maybe you don't, but there's like a 10, 20, 30% premium. There's also the futures premium. So like contango, right? The spot Bitcoin's trading at 20,000, 3-month futures are trading at 25,000. There's an arbitrage there. Like in the perpetual swaps market as well, the funding rates, you could harvest those. So there's all these kind of crypto native yield opportunities, and whether through arbitrage or whether it was just due to the excess leverage that collapsed, right? Because the only reason that this arbitrage existed was because there was a ton of crypto native demand for leverage, and that all collapsed. And so really this last bastion of quote unquote what people thought was risk-free yield, which this entire thing is just kind of like you're just like shorting tail risk, right? All these people were just short ball and didn't really realize it. And this UST was the last bastion of that risk-free yield. So all of the funds, all of the yield farms, whether knowingly or not, right? Like BlockFi wasn't in UST. They were lending to 3 Arrows, who was in UST, right? So once that collapsed, that was, kind of, and Luna, devalued towards zero, and then USD collapsed as well. I mean, that's $50 billion of real, not real, but value financial assets that just collapsed. And it was interesting because at the time I didn't really realize it, but in March, when Bitcoin, post Ukraine invasion, maybe it was April, when Bitcoin, touched 32,000 and then went on to rip towards 45, 46,000 again, while bonds and stocks were melting. It was like, oh, is this the oft talked about decoupling event? And then the reality was it was the Luna Ponzi that was kind of inflating the whole asset class.
Yeah. So from what I understand, it seems to me that the way that they did it was they said, well, we're going to be paying an interest rate on USD. And so that's going to get people to want to buy USD. And then when people want to buy USD, in order to transfer their USD, and this was the kind of stablecoin model, which is, you need to pay transaction fees. You have to pay the transaction fees with Luna, right?
Yeah, well, to get USD, you need to get Luna to swap into UST. So you need to buy Luna in the first place.
Exactly. So by giving interest on USD. This was, I remember when idiots like Raoul Pal were saying this is like a revolution of finance because we're, in the US dollar markets, we can't get an interest on dollars. But here we are because of crypto. We're able to give 10% risk-free interest on dollars. Like this is going to eat the global financial system, obviously, because everywhere else people are struggling to get 1 or 2%. And here we are, thanks to the magics of cryptography, we've managed to square the circle and invent the perpetual machine of finance. And we can give people 10% risk-free forever. And
20%.
20%. I'm sorry. Yes. 20% risk-free. And the reason is because, well, they're going to be buying. Oh, yeah. And Pavao in the comments says Metcalfe's Law. That's another great hit from Raul. So people are going to be buying the Luna. People are going to be buying the USDs to get the interest rate because their bank is not giving them interest. But they need to buy in Luna. So then the market cap of Luna goes up because of that. So Luna appreciates as a Bitcoin, so as an altcoin, and the market cap becomes higher. So the people who are behind Luna can then use that to buy more Bitcoin, or other assets, and then they can use these to pay off the interest on the USD.
And Saif, I forgot one thing, and sorry to cut you off.
Yeah.
This was also another one of the Ponzi mechanisms. Is the same way that when you take UST and convert it back into Luna, the Luna supply, because I take $1 of UST to get $1 of Luna, the Luna supply inflates a little bit to compensate for that. In that same way, it does when you go into USD, it does the opposite. So I took $1 of Luna, and I would burn it for $1 of UST, and that Luna supply would contract. So the circulating supply of Luna when this whole Ponzi was growing, as UST went from zero in total market cap to 20 billion or 18 billion, whatever it was, the circulating supply of Luna was contracting the whole way. So the market cap, as it was going up, the circulating supply was going down. So the Luna base asset, the price chart was just going up and to the right. That was the part I missed there, was that when you're converting into the UST, the supply, that float was contracting. So it was like on the way up, this perpetual motion machine was, this magic in innovation and finance, but it was, in the most kind of obfuscated sense for some people, just a Ponzi.
Yeah, and then of course, when the music stops, then it doesn't just stop there. Like you can't just, all right, well, people aren't buying USDs anymore. That doesn't mean that the USD is going to stay there and that the Luna is going to stay there, because you still need to pay the interest on the USD. And so effectively, once the growth rate of new buyers into the Ponzi is under the growth rate of the deposits, then you need to start making more Lunas in order to pay off the interest rate, right? And that's when you flip from the violent rise up and to the right to the violent crash down, and not even to the right, like it's just straight down, because now you're making more Lunas in order to pay the USD while the price of Luna is dropping, because less money is coming in and you need to print more. So initially you were getting more demand and you're decreasing the supply. So that's really supercharging the growth. And then on the downside, you're increasing the supply and you're getting less demand. So you're supercharging the crash. And that's why it went so quickly downward.
I think also this is one of the most fascinating things, and we'll cover this too when we get to FTT. I'm not trying to jump the gun, but the reality that in these markets, there's also, similar to traditional markets, I think it's very fascinating to study like George Soros shorting the pound and these massive speculative attacks we've seen. At the same time, whether it's UST, whether it's Luna, whether it's even Bitcoin to a sense, but Bitcoin, it's just a fixed supply asset. There's leverage or speculators. But more so like with FTT, what we've seen, there's these massive, massive speculative attacks where once the market knows, right? Do Kwon says, steady lads, deploying more capital. And I love that as just kind of like a punchline of like all of this junk, fraudulent leverage just unwinding in the system, and specifically crypto, but I like to use it for the legacy system too. But he said that as UST is at 98 cents and they're deploying and they're dumping 80,000 Bitcoin to defend this. And he goes, steady lads, deploying more capital. And the market's like, oh, okay, we're calling you bluff. And so for me, like, I wasn't on FTX or Binance or whatever as a US citizen. I can't do these things. But what you could do is UST traded on a perpetual swap pair. So I could take a dollar of Bitcoin collateral or a dollar of Tether, or really any FTX allowed you to use any shitcoin as collateral for these derivative contracts. And I can, if UST is at a dollar, if UST is at 98 cents, if it's at 90 cents, I can short this thing with 1x leverage, 5x leverage, 10x leverage, and I mean, it's a stable coin. It's max downside on the short end is, I mean, if it's at the dollar, it's nothing, right? So what you had was not only people trying to like frantically get out of UST, but you also had people both on Luna and UST shorting it into the dirt. And there was nothing you could do to defend that, right? Because there's no natural buyers of this thing except, Do Kwon and, flailing around trying to deploy capital. But once the speculators, once they saw kind of, blood in the water, it was over from that point.
Yeah, and this is kind of the beautiful thing about markets, and that, I mean, in traditional finance market, people will so for instance, a lot of people blame George Soros for bringing down the pound, and a lot of people blame financial capital for speculating against third world currencies and bringing them down, and not to defend those people, and well, I am going to have to defend those people, but ultimately what they are doing is not bringing down the currency. They're exposing the fact that this currency is weak. They're exposing the fact that this monetary policy is insane, and that the value of the currency is going up, and that the only thing holding up the value of the currency so far is really the central bank and the people in the government, just steady lads, basically telling the people steady lads, and a lot of people believing them, and a lot of people treating their decrees as if they are true. And so you see this in dysfunctional central banks all over the world, where the central bank will engage in insane monetary policy, print money for all kinds of insane things, and then just go out and tell people, hey, don't worry, this is going to be fine. We're deploying capital and we're going to fix things, and it's going to be all right. And people actually believe it. And I saw this in Lebanon. I mean, it's amazing how you would think otherwise educated. I mean, you don't even have to be educated. You just have to basically be literate and read some history and see that, yeah, you can't just print money to make the value of your currency better and hold up. But people will believe it. Well, they're wearing suits. They got on TV and they said, we're going to fix it. And they'll fall for it. And if you just don't fall for that, then you know that it's supply and demand, and they're just making more money. And so if you bet against it, you're going to expose it. If you keep betting against it, they're going to have to keep printing more, and eventually it's going to blow up. And so it isn't that George Soros break the pound. It's the Bank of England that broke the pound with a century of inflationism. George Soros just bet on the fact that it were to happen. And the bet, in a sense, becomes self-fulfilling. Well, not self-fulfilling, but the bet brings about the collapse, in a sense, because the fact that you're out there putting so much money, putting so much capital behind the idea that this is going to fall apart makes it more expensive for them to defend the peg, basically, and makes other market participants have to start to hedge against the possibility that you're right and that the central bank is wrong. And so that scares people away. But none of that would be the case if you had a sound monetary system. Like if the pound was redeemable in gold, no George Soros, nobody, no banking dynasty in the world could ever do anything to bring the value of the pound down, because the Bank of England has enough gold to redeem it, or even dollars. If they made it redeemable in dollars, they could defend the exchange rate against the dollar forever. But yeah, steady lads on its own is not sufficient.
Yeah, the speculative attack thing is really, really interesting, because I mean, Pierre Rochard has a really good kind of theory or piece about this that he wrote in like 2014 relating to Bitcoin and fiat currencies. But just the reality that if we're talking about fiat currencies here, or we can kind of bring it into the crypto, altcoin collapses that we've seen. And how some of the speculators, whether they sniff that out or they cost it, the reality that when you borrow in a fiat currency, you're basically creating more supply. Like credit creation in a fiat system actually increases the money supply, at least temporarily. And so if you're borrowing in massive scale like George Soros did, and then you short sell, you sell that into the market, and the exchange rate collapses, whether it's because of another participant is leveraged or they have no more reserves to defend that level. And then you buy back your short, you cover when the exchange rate has collapsed. And so I think there's some really interesting parallels there with the legacy markets and all of these shit coins that potentially a world where, we have an absolutely scarce monetary asset in Bitcoin against these malleable fiat currencies with a centrally planned cost of capital. We're getting ahead of ourselves here with Bitcoin at 16,000. It's extremely early, but I think that there's going to be some pretty massive things in the next 10 to 20 years that occur with government fiat currencies and Bitcoin that not really many people in the world have thought through, which gets me excited about where we're headed.
Yeah, and it's truly outstanding when you think about it. Here we are, it's 2022, Bitcoin is at 16,000, and this is, it's plausible. We can sort of think about it, but it's still extremely early. And then to think that Pierre Rochard was writing an article about this in, I think it was 2012 or 2013, something like that, in the Nakamoto Institute. And at that point, Bitcoin was like $100 or something like that, something in that range. And I mean, you need to get a lot more billions of dollars into Bitcoin in order to get it to this kind of level where it can be used to perform this speculative attack. But the dynamic is there, and the speculative attack is happening as we speak. It is taking place all over the world as people continue to accumulate more and more Bitcoin, and the value of the Bitcoin continues to rise. So it's we're definitely going to get into it. And Thomas is also mentioning in the comments in Lebanon is another great example. This is truly astonishing. If you lived through the last few years in Lebanon, at every stage, this governor of the central bank was out there on TV telling people, look, there's no need to panic. There's no need to panic. And people have such a ridiculous sense of normalcy, or sense of what is called normalcy bias, where they just want to believe that everything is going to be all right. Everything is going to be all right. Like, yeah, it's just a passing problem that's going to be okay. Tomorrow we're going to wake up and everything, and this nightmare is going to be over. It was just a nightmare, and people just continue to believe this idea that no, there's not going to be a big crash. There's not going to be a big problem. The Lebanese lira has now lost 95% of its value against the US dollar, at a time when the US dollar itself has lost about 10-20% of its value against real goods and services. So basically, it's been completely obliterated. If you have holdings in liras, they've basically gone to zero. They're an insignificant, infinitely tiny fraction of what the other is. And at every stage of the way, I mean, it's amazing. Like the exchange rate was $1 to 1,500 liras in 2019, early 2019. Now it's at around 40,000 liras per dollar. And at every stage, I remember this, like it went from 1,500 to 1,600, 700, then to 2,000, 2,500, 3,000, 5,000. I'm following this, and at every point in time, the central bankers and the fiat people stand up and tell you, this is not an issue. It's going to be all right. Everything is going to be okay. And Nassim Taleb famously, and after the banks had shut down and stopped paying out dollars and were only paying dollars deposits in face value in lira at the old exchange rate, and the exchange rate would drop to around 2,000, he was still saying there's no risk of a major collapse taking place. It's just amazing. Fiat brains just think that as long as the person in the charge of the government says something is going to be this, it's a decision for them to take. And especially if you're a loyalist to the government, if you're a big fan of the people in power like Talib is, it's just very hard for you to imagine that those people won't be able to press the button that's going to fix things. And it's we can just make it happen. And similarly, I think the parallels with shitcoin land are endless, because this is exactly what at every one of those things. Like when Luna happened, I remember the Luna fanboys on the internet were all about how Do Kwon is going to fix this. It's just that he's gonna deploy capital and everything is going to be all right. Like because it's just a button that he presses, and if you put your money with him, then you want to believe that he can fix it, and so you continue to just have that normalcy bias.
Yeah, I mean, Luna 2 almost saved it, right? It's quite amazing to see that. I mean, maybe not amazing, maybe sad. And I agree. Saif, it's interesting because I think a lot of people stumbled upon Bitcoin after, a decade plus of, whether it's like being kind of a gold bug or an Austrian or just, maybe a libertarian or having some distrust in the system post 08. For me, I stumbled upon Bitcoin as a math nerd. And then Bitcoin led me down all these different rabbit holes of, from a mathematical perspective, I cannot trust government currencies over the long run. From a mathematical perspective, what they're telling me is a lie. When post COVID, I'm sitting in lockdowns, got sent home from university as I'm falling down this Bitcoin rabbit hole. And, the things that I'm hearing these elected officials, which from broadly the people in my generation, Gen Z, in universities, I went to a fairly liberal university just for 1 year. People really truly believe these things. And I guess it's understandable to appeal to authority. Maybe it's naive. And not that I'm somehow awoken, but I think that once you peel back the onion, it's like, okay, whether it's incompetence or malice, these people are lying to you. And they're lying to you because logically, the math, the numbers, run the numbers, it doesn't compute, right? The promises they're telling you this, whether it's social security or, the inflation is transitory, all of this stuff, right? It's lies. And it's lies because mathematically, debt to GDP at a federal level is 120%. Global debt to GDP is 400%. So they're telling you that inflation is transitory, but there's mathematically no way inflation can be transitory. And so for me, like Bitcoin is like this. It was like, okay, like I get it. It's just math. It's numbers. It's like 100,000 lines of code or something. And it's not this like complex obfuscation machine meant to steal your money from you. And the reality is like actually nobody could steal your money from you if cryptographically, mathematically, I have these words in my head. No one else can take them. So for me, I stumbled upon Bitcoin first, and then all of these other rabbit holes and kind of orange pill, red pill, black pills about the world I came about. And it's interesting because a lot of people maybe are the opposite. Like I had no Keynesian indoctrination beforehand. And actually, I stumbled upon Bitcoin, the white paper, and the difficulty adjustment and halving at the same time as I go to university and studying finance and economics, get taught the Keynesian way, and why 2% inflation is the target. And I was like, why is this the target? And there was no answers actually. And so that was like it was such a dichotomy for me that I think that was part of the reason that I could kind of see through the farce early on and really never kind of get fully indoctrinated and have to kind of peel that back. It was obvious from the start that one system was about transparency and not trust, but verification, radical transparency. And the other was, political promises and lies.
Yes, but that doesn't answer the question, Dylan. Bitcoin doesn't pay you yield. It's not going to catch on if it can't pay you yield. Like, sure, you can keep your same share of the Bitcoin pie, but what good is that when it doesn't pay you yield?
Yeah, this is the question of our time. If we have to figure this out, if we ever hope Bitcoin can be money.
Yeah, we need to incorporate Bitcoin at yield at the protocol level in order for it to work. I hope the devs are working on something because I'm joking. For anybody who doesn't get my sarcasm here, I'm joking. I'm not calling for a fork of Bitcoin that introduces yield. The whole point, the whole reason the thing works is because there is no yield. Because if there is yield, the expression that I like to say is yield is the cheese in the mousetrap. There is no cheese just waiting for you. Nobody's out there giving you cheese unless they want to catch you. So if you find a very nice piece of cheese that's really appealing for you, you are what's going to be the victim of that cheese. You're going to get caught in the mousetrap. And this is, you see it in the crypto markets where, where does Luna get all of those 20% that they're paying people? Well, obviously they're getting it from the new people that are signing up. So effectively, if you're signing up today, you are somebody else's yield. You are the yield that is being farmed in this project. And it's true for everything. It's true for fiat money as well. People think, well, the government is going to pay me 6% on this treasury bond, or they're going to be paying me an interest on a saving account that's protected with the FDIC. Well, how are they making all this extra money? Where is the productive activity that they're doing? And you realize, yep, they're just devaluing the currency and they're devaluing the savings of new people putting in their savings. So if there is yield, if anybody gives you a promise of a fixed return, there is a scam involved, because money itself is sterile. I think this is the fundamental fact that people really hate to come to terms with in fiat world. Money is sterile. Money doesn't make more money. Like it's not something that can make more of itself. And if it could make more of itself, then it's devaluing itself. So it doesn't create more value. You get more units but the value stays the same. But in order for something to create value, it needs to be an economic good. It needs to be actually creating more economic goods. And that's a process that involves risks. And that's a process that requires management. That's basically, if your money's going to yield something, it's going to have to be invested. And so an investment can never offer you a fixed return. It doesn't work that way, because it could go to zero and it could be wiped out, and the return on it can be variable. So nobody can tell you, hey, to give me your money, I'm going to invest it, and I guarantee you 1%, 2%, 5%. There's no way to guarantee it. They could make 100%, they could make negative 100%. There's no guarantee on it. If you're gonna make a yield, you can't just hold on to the money. That's the key thing. If somebody's telling you your money is available for you, but it's also making a yield, that's clearly a scam. Because if you're going to be making a yield in any way, that money needs to be exchanged for a productive good. You need to give that money to somebody to buy a cow from them, and then the cow yields milk, and then you sell the milk. But that means A, you no longer have the money because you now have a cow, and B, there's a risk. Cows die. Cows get sick. Cows require active management. You need somebody to milk the cow every morning. So there's no possibility that you just have a cow yielding milk for you and also have the money available for you. And if anybody's selling you that, you're what's being milked.
Yeah,
you're the cow.
And this is you're the cow. This has been quite the lesson, and it's been a tough lesson for a lot of people. The Bitcoin crypto ecosystem. I honestly, I don't even like to refer to it as an ecosystem or an industry. Like there's been a lot of chatter the last 2 weeks. Like, this is the worst, this is the worst month in the history of our industry. And it's like, well, yeah, I mean, I guess there's somewhat of an industry, but it's mostly, financial bucket shops and unregulated, unregistered securities. And when I say like unregistered securities, by no means am I a champion of the state. Am I calling for more regulation? Am I calling for more bureaucracy? I'm actually calling I probably want the opposite of that, and kind of how I lie on the political spectrum. But regardless, like what is the crypto industry, right? We have this Bitcoin thing. It's just this protocol. It's like almost this clock that just continues to tick no matter what anyone does, thinks, says, and it's a result of human incentives, economic incentives, that this thing will just continue to go. There's a reason hash rate is at all-time highs, while price is 80% from the previous highs. Like, there's a reason for this. And then what else is there? There's perpetual motion machines and Ponzis and other protocols and yield farms and bucket shops like FTX and Celsius but there's some legitimate financial services, yes, but like I think that is just part of the finance industry, right? Like this is not this like separate thing, right? Like what the genuine innovation that I see people so often describe is not really all that innovative, right? It's like, oh, stable coins. Okay. So you slap a commercial bank IOU on a ERC20 blockchain. Okay. Like, okay. Is that really innovative? Or is that just kind of basically a reintroduction of this thing that we've already kind of had, this trust model that we've been using for the last 100 years? Right, like you're sending stable coins on Tron. Like, okay, I guess that's cool. It's cheaper. It's certainly cheaper than Wells Fargo or some of these cross-border remittance payments. But like, is that anything new here? Or are we just kind of slapping a lot of the old system in an unregulated fashion into this new kind of system? And I think it's that's the answer. It's like there's really this industry, as a lot of people like to describe it, is not all that, whether innovative or exciting really for me. I think it's a lot of it is just kind of false promises and a lot of people looking to pump and dump and get rich quick. And for the most part, there's certainly some speculators and some people that are in it just for the gains in Bitcoin land. But there's, from what I've seen and from the amount of Bitcoiners that are completely unfazed about all of this, don't care about FTX, don't care about any of these Ponzis, are actually happy the exchange rate has gone down because they're going to buy more and they have no plan on selling for the next 10 years. It's unlike anything I've seen in the crypto industry by multiple orders of magnitude. And there's a clear signal amongst all of this noise. And that's why I'm here. I mean, that's why why I post about Bitcoin every single day, in some way or some form.
Yeah, I think the extent of the capitulation in the shitcoin industrial complex over the last few weeks, in particular after the FTX blow up, has been absolutely amazing, even for me. Like the number of people that are just, oh well, crypto's never gonna make it into the mainstream because of this, and all my normie friends are really angry, and they tell me this is the end of crypto, and I can't believe Sam would do this. I can't believe they'd do this. Like there's just way too much false hope pinned on individuals to do things, and like Bitcoiners don't have that. Like, if your Bitcoin thesis is going to be compromised by Sam Bankman-Fried turning out to be a fraud, your Bitcoin thesis is broken. Your Bitcoin is broken, and if your shitcoin depends on him not turning out to be a fraud, then yeah, you shouldn't be shitcoining. And like, I think you're right. Like a lot of people think of the perspective that if you're a libertarian, then you must be for anything that the state opposes, and that's not true. You know, there are police officers arresting thieves every day, and there are police officers apprehending killers. That the fact that I'm a libertarian, that I'm an anarchist, that I'm against the state, does not automatically make me want to side with the murderer and the thief and anybody who does bad things. You can be a bad thing and still run into trouble with the state. I could believe that the state should not exist. I could believe that taxation is illegitimate, but I would welcome a policeman shooting somebody who's going around shooting people. You know, that's objectionable for me. It is objectionable for me that the policeman is financed through a taxation monopoly. As an anarchist, I believe we'd have much better security if we did have private provision of law, and we'd have private police forces. There's something, you know, if you're interested in reading more about this, check out Herman Hoppe's edited book, The Myth of National Defense, which talks about law and order and how it can be provided on a free market. Yet that does not mean that I support any person taking people hostages or arrest or robbing or killing or carrying out any crime. And I welcome somebody stopping that pressing crime. So this notion that we're supposed to embrace, tolerate, and encourage fraud just because the government might be against it, or because, you know, they're using cryptography and somehow we're all on team cryptography, that you know, if you just use private keys and public keys, then you're on my team and everything that you do I'm responsible for. I think this is just, it's affinity scamming. It's essentially you want to get yourself as part of a community so that you can use that community as a way to market your product to them, and that's, I think, what all the shitcoins do. And no, I don't have to be excited about any of those things.
It's been quite interesting the last 6 months was, help use my platform, like particularly post Lunar collapse, to be like, okay, Celsius, get the hell off. These yield farms, get the hell off. Leading up to it, FTX, get the hell off. And I've had hundreds of people, whether over DMs or in person at some conferences, thank me. And I've had at the same time, I've had probably, probably the ratio is 1 out of every 50 people, 1 out of every 25 people that thank me and say, I got off because of in part your warning. People come up to me, or much less so in person, but more so, behind a screen, DMs or Twitter, say, you caused this, you caused this bank run. And for me, my response is, and half the time I don't even give them a response because it's not even worth my time. But it's like, if you think a man on Twitter saying some mean words, or in your terms, causing panic or causing this run, if you think that is the reason that your bank, neobank, or protocol or exchange collapsed, then I don't know what to tell you. Because I mean that's part of the reason I'm speaking up on a lot of this stuff is if the foundation that you're building this thing on is so weak, is so fragile, that some person saying words on an app can cause the whole thing to collapse, then it was never ever gonna be something that lasts anyway. And so like Celsius, right? You're running not even a fractional reserve. You're running a derivative bucket shop. You're taking user funds, you're plowing them into Luna, you're plowing them into UST. They lost hundreds of millions of dollars via DeFi hacks. You're just throwing these things, as Sam Bankman-Fried likes to call them, in this magic black box and hoping it spits out more money your way. And the reality is it doesn't work. So me using my platform, and never mind me, just anybody saying, hey guys, this is not a good place to hold your money because your screen says 1 Bitcoin, but that 1 Bitcoin is not in an address waiting for you. That 1 Bitcoin is in whatever the hell Alex Mashinsky or Sam Bankman-Fried was, whatever the hell they're doing. And so you should probably get the hell off because this is a game of musical chairs and the music has basically already stopped and people don't realize it yet. And so, I mean, like a fully reserve bank, this is the thing that I think people, it's mind blowing that it's so misunderstood. If I, I'm not even going to say one exchange or the other, but just for instance, because this is the most well-known name, if there's a rumor, right, and it's completely false, it's Coinbase lost, 100,000 Bitcoin, right? And this is not true. I'm just hypothetical, and it's not true. It's a completely made up rumor, but someone high profile states it. Hell, I say it. It's completely made up. I just make it up. And Coinbase is missing 100,000 Bitcoin, and all of a sudden everybody goes and rushes to Coinbase and withdraws all their money. And Coinbase is, despite all the shitcoins they list and despite everything else, just say Coinbase is a legitimate shop. They have all their user reserves, which is not my discretion to say. I think it's up to you to prove that, and no one knows until you have your coins in your wallet. But say they process every withdrawal and every single user asset, Bitcoin, Ethereum, USDC, all of these shitcoins get pulled off the platform, and they remain perfectly fine. What harm was done, right? That's not their business model. Is trading fees. Their business model is processing fees from an order book, right? Like there's no money to be made for an exchange on the withdrawal process. I mean, maybe a little bit, but that has no effect on their business model. And so if your exchange business model gets collapses because people withdrew their assets, you were insolvent to begin with, right? So I think it's mind blowing that this is misunderstood still. And the fact that, causing panic, is not why, your exchange collapsed. Your exchange collapsed because they were either fraudulently running a fractional reserve from the start, right? Or, they had some impairment loss along the way and just didn't disclose it, because that would have been the end of their business.
Yeah, and I should also add, not only would you be unlikely to bring them down, but you're also giving people who know what's going on in Coinbase an opportunity to make money from that. If you say this, if you have a relatively high profile, let's say, 10 big influencers on Bitcoin Twitter decide that they want to take out the shitcoin casino because we are just mean maxis. And we go out and we make a rumor about about a crypto exchange, and we say they're insolvent, and they're actually not insolvent. Well, that's a great opportunity for you if you are an insider in that casino and you know what's going on. And then we say that this thing is insolvent. Let's say we have pretty significant reach. A lot of people start selling the stock. The price of the stock starts to dip down. Well, that's an excellent opportunity for insiders to buy that stock at a discount and keep defending the price, because the price is going to shoot up, because eventually, no matter how many people try and withdraw, maybe we do cause a bank run and 80% of people go and withdraw their assets. So what happens? 80% of people get their assets out. Eventually people are going to realize, oh wow, well, the money is still there. All of us managed to get our money. Withdrawers are still processing. It's going to be restored back to its original profitability. Stock price is going to go up. All that you've done is that you've given the people who believe in the exchange the opportunity to make money off of the people who are shorting it. So you would lose if you were spreading rumors against something that is solvent, that is solid. And so, yeah, it's ridiculous that people would blame you for it. So we get to the next one. The next domino to fall was Celsius, I think, after the Luna. Well, there was 3AC and Voyager, I think, and Voyager's kind of still in limbo. 3AC is pretty straightforward. They were just a lending, they were just a hedge fund, and everybody called them the smart money in crypto land. But it turns out pretty much anytime somebody says somebody is smart in finance, all that they're doing is just making money by lending. They're lending money that they don't have, and they're making a lot of profits on it. I think there's just nothing to do in finance that's truly innovative except Ponzi's, basically. It's just make a bunch of buzzwords, make an actual Ponzi. And if people are calling you innovative over new stuff, you're not coming up with new stuff. There's nothing new under the sun. It's the same Ponzi that has been there for hundreds, thousands of years. People have been doing the same trick. there's really nothing new there. And it's just we always find new ways of calling ourselves geniuses for playing the same old trick. So what was 3AC's deal? Do you have any insight on that?
Yeah, I mean, this goes to the broader kind of crypto bubble of 2021, which you saw obviously Bitcoin go from 10 to 60,000. You saw all of the Ethereum DeFi wave, and then behind that, right? Because this is this kind of thing, and to go back to that, there's that great clip, and I think you've shared it multiple times, of SBF talking about these DeFi protocols, and then he's like, well, you have this black box, and there's one black box that's worth 200 million. So people go to all these other boxes and say, well, this box right here is 200 million, so maybe this one's worth 100 million, and this one's worth 100 million also. And so you had all of these crypto networks, right? The L1s, the layer ones, right? Where supposedly the smart money, the Three Arrows Capital of the world, and the Alameda Research and Multicoin Capital, and all of these guys were investing in the next generation of crypto assets, right? The crypto ecosystem. And the entire thing was just all a liquid leveraged beta. It was you had these illiquid coins with small floats that were pumped by the same 3 to 4 actors. I mean, obviously there was retail speculators and traders that were hopping on the wave, but I mean, Three Arrows, right? They were pumping all of these illiquid shitcoins that they got seed allocations towards. They'd use their platform to pump them up. They were big in the GBTC arbitrage trade that turned bad, right? That the premium went to a discount. And then, we find out that, they were lending unsecured from places like Voyager, borrowing Bitcoin and dollars. And they were going to places like Genesis Capital, and they were pledging, AVAX, Avalanche coin as collateral, right? So these, like, the entire crypto ecosystem, if you want to call it that, it's in a similar way that, when the stock market, when the Dow Jones index is down 6%, right? The Dow Jones index rather is down 6%. It doesn't matter if your stock's really good or really bad, right? Your stock's probably down on the day, right? Because it's just a broad, like, liquidity tide, if you want to think of it like that. And the same way, like, if Bitcoin is down 10%, I don't care how supposedly good or bad your shitcoin is, it's probably down on the day as well. And so this whole thing is cross collateralized, just correlated, and they're all really riding on the back of Bitcoin's beta, right? Of Bitcoin's market movement. And so these people, whether they thought they were smart money or they knew that it was all just one trade in a way, one trade where these shitcoins in Bitcoin terms on a long enough time frame are almost all down only, right? All of the plot every altcoin you want in Bitcoin terms, and most all of them are making lower highs, right? And are just trending lower on a Bitcoin denomination. And so really, I mean, these guys were just time, but in a bull run, it doesn't matter. And they were deep in the Luna UST Ponzi, took significant losses and tried to dig their way out in leverage, and basically, just forcibly liquidated. And so, that's how it should happen. There's no bailouts here. And the coins that they thought they had were transferred to more patient allocators. I think it's a beautiful thing.
Yeah, absolutely. And of course, everything is intertwined because it's really the same 5,000 Bitcoin doing the rounds in all those financial institutions, and everybody lending them to everybody else and then borrowing against them and rehypothecating them. And then you get billions upon billions of market cap in all those institutions. But really, it's the same money. So 3AC starts to have trouble. Celsius goes down. What was the deal with Celsius, and when did you start suspecting it?
With Celsius, I mean, it was always an interesting thing, and really with any of these yield products, and I think Celsius was one of the more shady ones, just because of the head Alex Mashinsky going out there. They had somewhat of a cult. They had their own token. These are all red flags, right? Kind of like the first admissions of like, maybe this is fraud, maybe not. I don't know. I certainly have no inside information here. And then you could just see, right? And I don't spend my day to day tracking, like some of these on-chain sleuths were following these wallets for months on end. But I keep my eye out there, and I follow these people that are following these things. And I say, oh, wow. So Celsius just narrowly made it out of the Luna UST Ponzi with just a slight haircut. And I'm pretty sure they put out a statement. I could be wrong here, but I think they put out a statement saying, no, don't worry, guys, we got out. It was like, Oh, so you're in the Ponzi, but you got out. So that's really reassuring here. So from there, it was like, hey guys, and there was also, they were in the staked ETH trade, right? So here's here's another financial innovation, right? The staked ETH that you can't unstake because they haven't written the code yet. And so they have the Lido staked ETH, right, which gives you a derivative token that is liquid. But it's similar to GBTC, right, where you can pledge the Bitcoin in and you get a GBTC token or share out, but you can't reverse that until the code is shipped. So they were heavily in staked ETH, right? And so as the staked ETH not peg, but that one way mechanism, as that started to falter, we could see that Celsius had loads and loads of ST ETH, staked ETH, Lido staked ETH, which is very, very illiquid, right? So any leverage there, any exposure there, and when it started to bleed, that was like two real signs of like, hey guys, we can see that this is with high probability, just via heuristics, on-chain heuristics, and the fact that ETH is an account-based model, Bitcoin is a UTXO-based model. So the on-chain tracking and just what you can do, quote unquote, on-chain with Bitcoin is very, very limited in nature. I mean, that's a feature, not a bug. With Ethereum, it's an account-based model, and we can see like, oh, this account, this address is in a yield farm, and they have borrowed 100 million USDC against XYZ collateral. So we can see all these things. And when I saw Celsius in big size and narrowly avoiding the UST implosion, and then having hundreds of millions of dollars of staked ETH, it was like, okay, these guys are in a bunch of one-way trades that they can't get out without massive slippage. And just based on their execution on some of these things, I would get the hell out. So I mean, I had no exposure to Celsius. It wasn't really anything personal whatsoever. But it was like, okay, I feel like I should use my platform here to alert people. And the Celsius proponents will say, I helped to kind of spark or create panic in a bank run. My perspective is this thing was destined to collapse, and anybody that I can help and inform and put in the know about this, the better.
Yeah, that was, for me, there was a panel in Hong Kong in 2019. I was at a conference, Token 2049, I think the name of the conference. Yeah, Token 2049. I was put on a panel on CNBC with Mashinsky and Tone Vase. And I didn't know what Celsius was, but there he was. He was the whole sales pitch that he had was, look, banks are robbing you because they don't give you interest rate. As if interest, yield is your natural right. It's a natural human right that everybody should make 7% on their money because money just makes 7% on its own. If you just put it there, it just multiplies. But the banks are taking it from you. And we are using crypto to make yield for everybody and give everybody 7%. And it's just insane because, 7%, you're doubling the money in 10 years' time. And how did you double everybody's money in 10 years' time? There's no way that this model would be sustainable. He was... in retrospect, I think he's a great example to look at to see how manipulative people behave, and that he's instead of defending himself, he accuses others of doing what he's doing. And so we're being deceptive, we're being discouraging of people, we're being anti-innovation because we're bringing this up. And interestingly enough, I think this is a very common thing you see, that right before the fall, these people start lashing out specifically at Bitcoin maximalists. And so there was another video of Mashinsky saying, the Bitcoin maximalists are ruining Bitcoin because they're telling people to take their money off of platforms and to hold their own keys. And now all the money that's held on their own keys is getting lost. I don't know how he got that stat from, but he said everybody's losing their money by holding their own private keys, and instead they could be keeping it on platforms and making returns on it. And this is the kind of, this was the point where they were beginning to get desperate to get more people to give them money. And it's very interesting that, in their desperation, they always lash out against the Bitcoin maximalists who are just repeating the same lesson. It's not personal. It's not about you. It's just, you can't make 7% forever. You should just keep your money with yourself. hold on to your private key. That's the whole point of Bitcoin, and that there's no authority that can make more Bitcoin. And I think the key thing to keep in mind here, and this is where the difference is between these crypto yield products and fiat, is that in fiat you can have yield forever because you can always have a central bank that destroys the currency or devalues the currency in order to pay off the yield. So yeah, fiat banks can offer interest rates. They don't do it much anymore, but they can theoretically offer it. And when things go bad, the central bank usually steps in and prints a bunch of money. There is no central bank in Bitcoin. There is no authority that can make more Bitcoin. There is no Satoshi bank out there that can decide, all right, well, too much distress in the market, too little liquidity, let's make it 22 million, help each other out because, to save the economy. There is nothing like that. There's 21 million Bitcoin. And this is what I really love about Bitcoin. And I mentioned it in the fiat standard, which is every 10 minutes, you get a full universal audit of every single last Satoshi. And every 10 minutes, there's nowhere to hide. Every 10 minutes, you either own the private keys for this thing or somebody else owns the private keys. And so there's no way of bringing in the kind of fiat games of, yeah, my money is in this bank and that bank has lent it out, but it's okay because the central bank is behind them. So, we're not really sure how much money there is and we're not really sure who owns the money, but it's all going to be all right because, the guys in the suits got on TV and told us it's going to be all right. Bitcoin doesn't do that. Every 10 minutes, you've got Pierre Rochard and his army of number-running node runners sitting there and auditing every single last Satoshi. You either have it or you don't. If you don't have the private key, you have a bunch of promises from a bunch of people, and there is no force on earth that can force them to hand over your coins. They can just take the coins. And so you better really, 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 really trust them because nothing other than you trusted them can give you those coins. So, unless they're very close family, then you're probably misplacing your trust in them. There's no way that anybody can bail you out if this goes bad. But the whole business model, they're copying, and this is the point that I keep making, they're copying fiat games into Bitcoin and doing it without a central bank. And this is because these are people who grew up in fiat world. They grew up in a world in which we have financial perpetual motion because the central bank is always ready to bail them out.
Yeah, it's certainly fascinating that we have basically this completely transparent auditable ledger. It's trivial to audit this thing. I mean, I can, with an app on my phone, actually connect it to my full node. Maybe with fully noded. I can run the code that audits the entire supply. It probably takes 2 minutes. With my full node on my laptop or my Raspberry Pi, I can sign proving my keys, right? That I own this Bitcoin or own this UTXO. And so it's maybe funny or sad or ironic that with the blow up of Three Arrows Capital, with FTX, and I'm not saying that these guys are fraud, but it was funny the statement that Grayscale put out on Friday is like, hey guys, I posted and a couple other people posted, hey, can we see the Bitcoin? You guys have all this Bitcoin supposedly. Can we see it? And it's so trivial to just literally press a command, say, these are our keys. It's put in the blockchain. You sign it. You sign an address, and only you can do that with your private keys. And Three Arrows Capital has a PDF that says 2 billion AUM, and they sign it. And it's like, okay, checks out, guys. It's just it's absolutely asinine, in my opinion, that we have this innovation, and never mind Bitcoin. Bitcoin is obviously the innovation here, but even with the shitcoins, they're all equally transparent, right? And so we have this system of lenders and hedge funds and shops, lending desks that are all that are playing, like you said, the fiat game. And never mind, they're not even using these transparent ledgers to their benefit or to their risk models. They're lending billions of dollars to two guys with a PDF that says 2 billion in assets, and they're like, yep, checks out. Like Voyager's lending unsecured to Three Arrows Capital. And so I understand that in a up only bull market, whatever, and you have to compete on lending standards and all this. I get this, and I get that these incentives lead to these blowups, these misincentives, these malincentives. But at the same time, it's just ironic to me that we have a completely auditable, transparent system, and yet here we are watching all these blowups and watching all these paper Bitcoins watching FTX, who sold their customers 70,000 Bitcoins, go bankrupt with one Bitcoin, 1.0, 100 million Satoshis in custody. And paradoxically, right, because, FTT token implodes and they have all of these, garbage assets that there's no natural buyers to implode because of all the speculators that poured on and because there was a bank run. And they were short 70,000 Bitcoin. And funny enough, paradoxically, the Bitcoin exchange rate tanks. And it's like, you know what? There's a bunch of stackers and hodlers of last resort that are just laughing right now, that are saying, these are stupid games. And the end game is unchanged completely. And as a result, the people that are buying this thing, the people that aren't going to be selling this thing, that understand this thing, are acquiring a greater percent of the free float. And that's why Bitcoin never is, like, every time it falls 80%, 85%, 90%, why doesn't it die? Why is hash rate at all-time highs? And it's funny because, there's like two distinct people, or not people, but there's the shitcoiners that are saying, you don't understand the innovation of our blockchain. This time is different. You boomer maxis, you don't understand the innovation. And then there's the macro people that, especially there's people that have really deep understanding, supposedly deep understanding of how broken the system is, of the debt-based system, where there's no longer gold, there's no any hard money collateral backing the system, and we're on a purely debt-based system with the debt and the assets, the debt that's underpinning the assets functioning as the base level collateral. And we're so engorged in debt, basically a decade plus of 0% interest rates. Finally now we're seeing this burst of consumer inflation. But there's people that are saying, yeah, there's no way out of this. There's no way out. What do we do? And then there's the Bitcoiners that are saying, like, hey guys, look at this thing. We maybe, we really think we have an engineering solution. And both sides, the crypto people and the macro people, are saying, you stupid Bitcoiners, you guys, you just don't understand, for X, Y, or Z. And we're just saying, all right, we'll play the long game here, and we'll see who's laughing in the end.
We're just saying, have fun chasing yield, basically.
Yeah, exactly.
All right, so I want to get to the GBTC and I want to get to the fiat markets. But before, BlockFi, what is your take on BlockFi? What happened there?
Yep. Really the same story. They were caught up in the GBTC thing. I didn't have any inside information as to the contents of their balance sheet or anything else. It was just clear that there's a daisy chain of lenders in this space, and that they're all interconnected and they all have exposure to each other. So when Three Arrows blows up, when they supposedly got a bailout, and this was the fishy thing about FTX and Alameda coming out in the summer and saying, hey, we're bailing out Voyager, we're bailing out BlockFi. The first question was, how do these guys have any money? And then the second thing was, and this was the first thing that sent my alarm sirens flashing, was, okay, you're FTX, you're bailing out Voyager. Why are you borrowing $370 million from them in their bankruptcy proceedings? That was like, oh, you're bailing them out with a credit line, huh? Okay, well, noted. We'll see what comes of this. And I had no conclusions, but only just like, this seems odd. So with BlockFi, I think the sad thing is there was no one that had interest in acquiring a bad loan book, right? Liquidity troubles or issues is fiat speak or maybe crypto speak for functionally insolvent if you need to mark to market your assets and liabilities, right? If you need to sell down your assets to meet your liabilities, your consumer withdrawals or whatever, your liquidity issues are functionally in insolvency without a lender of last resort, without someone to buy your fire sale assets. And so that's the story here. And I was extremely surprised that anybody still had any money in BlockFi after what happened 6 months ago, and they continued to stay open because of this FTX credit line. I think the sad thing was that FTX and Sam basically sharked them into stealing their customer assets to keep their Ponzi going, which is sad. But at the end of the day, all of these things were destined to fail in the end. Even some of these platforms, as of 2 weeks ago, were offering 9% on USDC stablecoins. Where is the yield coming from? This is Alan Farrington is having a field day. Where is the yield coming from? And there's no answers to this other than you're taking excessive risk, right? And that's fine as long as the risk doesn't blow up, as long as the music's playing. But it's clear the music had stopped 6 months ago. I mean, that was abundantly clear. But now after this FTX implosion, it's even more so clear. And it's kind of funny now where, we had the inverse of this in the DeFi summer, where DeFi was offering you 10 to 15 to 20% yields on your stablecoins. And now you get, with your custodial trust, commercial bank IOU stablecoins on chain, you get 2%. And, you can get 4.7% on a 3-month treasury bill. And I'm not saying that's attractive or not. I'm just saying, this supposed innovation, right? This cryptography motion machine where we can somehow just get yield on a blockchain now is actually less attractive than just going in Fidelity and buying a short-term treasury bill ETF. So, quite the change of events there.
Yeah. And I think, what the FTX trying to buy up all of these things showed is that it was, as I was saying earlier, it was all the same money that was recycled. And so they needed to prop them up in order to keep their own pretenses going. And so, and then, the really, really sad part was the fact that, as you mentioned, FTX bought them so that they would transfer their customers' Bitcoin, and effectively they lost it. If they declared bankruptcy before FTX had taken them, then you would have had Chapter 11, and you would have, most BlockFi depositors would have made some fraction back. But now they're just FTX depositors. They'd be lucky to make, I'd say, 3 cents on the dollar, I think, at this level. But I think it's really sad. And looking at BlockFi, I don't know well enough. I haven't looked into it, but I think my impression is I don't think there was any kind of real malice there. I don't think that the people behind it were thinking of themselves that they're trying to rob things, that they're trying to rob their customers. They weren't. They were not engaging in a Ponzi. What they were doing, they were just doing basic fiat finance, and they were completely unable to imagine that Bitcoin-based finance would be different. And I genuinely think the CEO, Zach Prince, he put his name out there. He was constantly trying to make the thing work for his customers. And there was that famous bet that he made with American HODL. He bet his 2 Bitcoin of his own money against 1 Bitcoin from HODL, saying that BlockFi is going to continue operating for, I think it was 15 years or something like that. I genuinely get the feeling that he truly did want to build a useful product. But the problem, again, is that he learned his finance in fiat world, and he learned the finance in the perpetual motion machine that is fiat finance, which makes people think that perpetual motion is possible. But it's only possible because you have a money printer in the background. This is what it really comes down to. And so then when you go to a world that doesn't have a money printer and you think the perpetual motion machine is possible, then you're going to get burned, unfortunately. And I think at a very basic level, the business model for him was, we can continue to raise money from our VCs that will continue to make this going. This is what it ultimately comes down to. I know somebody who spoke to him at some point. I'm not going to name names, but the idea was pretty clear that in his mind, this is a game where you raise money from VCs. At the end of the day, well, how are you going to be sustainable? Well, we're going to get more VCs. And this is, again, another part of fiat disease where people just don't consider the fact that for a business to be sustainable and profitable, it needs to make revenue, and it needs to make revenue that is higher than its expenditure. You can, you could go through an investment phase where people will invest in a business. It could be a year, 5, 10. People could invest in a business for 10 years in order to continue to, support it as it gets to the point where it turns a profit. But if there's no scope for at any point in time turning a profit, then you're just not going to make it. And I think it's just they were a victim of their fiat minds, their fiat mentality.
Yeah, I agree. I think BlockFi was, for better or worse, maybe legitimate is not the right word. They were honestly trying to build something like you said. The reality was to do this, to capture a yield, you have to go out upon the risk curve, because whether you're talking about Bitcoin or some of these other things, these other assets, and they were doing stuff with stable coins or whatever, which are more malleable, I guess. But there's no way to get yield in this ecosystem, or really anywhere, without when the risk-free rate is 0, without taking risk. And so that the risk was, lending to borrowers with collateral, right? But what happens was they had GBTC collateral. And so as they're liquidating this, they admittedly took, tens of millions, or maybe it was closer to 100 million in losses and impairment losses because of the liquid collateral, right? So this is just, part of the symptom or the disease, like we were talking about. It's you have to take risk. And I think this is maybe part of the wrong advertisement or false advertisement of this yield industry, this yield complex, is people think it's similar to going to Chase Bank, and maybe it is similar, but they think that the 2% yield that they get, their Bitcoins are there, and they're just magically sprinkling interest upon their Bitcoin that's staying in this address waiting for them. The reality is that Bitcoin is not there, and it's only in the UX of the app that their Bitcoin still says 1 BTC, but behind the scenes they're taking that 1 Bitcoin and they're lending it, they're hypothecating it, they're leveraging it, and it blew up. And so a lot of lessons learned, but I think the silver lining to all of this, if there is one, is that there's, and Michael Saylor tweeted this and got a lot of hate from a lot of people because of this statement, but a lot of Bitcoin maximalists were, whether they know it or not yet, minted in the last couple of weeks. And, there's people that say crypto is dead. Well, crypto is dead. Long live Bitcoin is what I think comes about from all of this.
Absolutely. I think, when the Bitcoin price rises, we get all of these effectively parasites and distractions on the side that start selling all these incredible visions of the world with Bitcoin, where we're going to have Web3 and metaverse and a new economy, and it's going to break all the rules of old finance, and we're going to get rid of scarcity, and we're going to make $1 trillion economy out of JPEG receipts, and all of these ridiculous fantasies are supported by the price of Bitcoin rising. And then when the price crashes, you see what survives, and basically what survives is, it's very, very simple. It's a very basic technology. It just does a new block every 10 minutes. And it issues 900 coins every day, and that's it. And you get your share, and every 10 minutes you get to look at where your coins are. You make sure that they're still at your address, and you know where everybody else's coins are. And that's it. That's the only thing that we have in this entire ecosystem that's an actual workable, sustainable, safe product. It's the only thing that I feel comfortable recommending to anybody with a clear conscience. It's the only thing that is actually that you can be comfortable won't blow up entirely in a year or two, as is the case, I believe, with pretty much everything. And the only when you look at it, really, this is the fate of everything in crypto. There's the few altcoins that are at the top which get the most hype, and so people think it's Bitcoin and the others, but in reality it's Bitcoin. And then out of the 21,000 others, there's a few that haven't been destroyed yet, and that's it. But for pretty much everything, everything has been destroyed, and everything is on its way down. And it takes a while for dirt to circle the drain, and just because some dirt is left doesn't mean it hasn't. It's not circling the drain. It is. So then we get to FTX. I don't know if you watched, but a couple of weeks ago I did a podcast on FTX. I don't know if you saw it, but it was strongly based on your thread and my thread, which was a running commentary on your thread to an extent. So perhaps there's not much to add to it, unless you have anything you'd want to add on what you think about FTX.
Yeah, I did see it. I saw a little bit of it. Someone recommended that I take a look, and it was awesome to kind of see you document the thread and all of this going out. I mean, it was certainly vindicating. Not that I take any pleasure in the misfortune of others. I don't. Personally, whether personal relationships, some business relationships, just talking to people behind the scenes on the weeks preceding it. Really, I mean, post the CoinDesk leak, I was really surprised. Not everybody, especially the people in the crypto, the crypto natives per se, the people with JPEG profile pictures that trade derivatives of shitcoins all day, and all the power to you if that's what you do. I was amazed that they couldn't see it. It was like, okay, guys, I don't know if anyone's asking questions here, but their balance sheet, if this is correct, and I would assume it's still correct because there's no one legitimately that's trading this thing or moving this thing with any sort of size. Their balance sheet is telling you they're levered against a shitcoin with no natural buyers. Does anyone see a problem here? And I was like, we said it was like 14 billion of assets and $6 or $7 or $8 billion of liabilities. We don't know what the liabilities are in. They have billions of dollars of FTT. some of that FTT is locked, right? If you look at, this is the crazy thing about the Alameda story, is that they created or helped to create or co-found all of these shitcoins that had, for instance, some of the shitcoins in the balance sheet, Oxy and Maps and some of these other ones. If you look into them, and I did no due diligence 2020, 2021, I didn't buy any of these things, but they'd create a token, right, with say a circulating supply of 10, right? And the fully diluted valuation, or the fully diluted supply of this token would say 10 units is 2,000 total units that are going to be in circulation eventually. And so what these guys would do is they'd unlock, they'd get all of this allocation that's supposedly locked, right? Similar to like VC vesting periods, right? Where your shares of this private equity are locked for so long, but they would do it via smart contracts. And they'd mint all of these, like Maps was legitimately a DeFi protocol token in an analog like app, like a map application. So they said, here's a map, it's Apple Maps, but we're putting a DeFi protocol token in it. And they sold it as this new vision to the world, right? And at one point, this Maps, if I'm not mistaken, the fully diluted valuation of this was in the tens of billions of dollars. And so they'd list these things, they'd list these tokens, they'd list the spot market on FTX, they'd send the tokens to the moon. And remember, they can't touch these tokens because they're locked allocations, correct? And then they'd list the perpetual swaps. And with the perpetual swap contracts, these derivative contracts, I can take $1 of exposure or $100 of exposure, and I can sell or buy, but there's no incentive to buy. I can sell with my $100 of collateral. I can sell thousands of dollars worth of exposure. So even though their VC investments were all locked and supposedly liquid, they could use these to just dump on retail, which is what they did. Amazingly enough, they actually lost money in 2021. But the reality was all these tokens that they owned, the entire Solana ecosystem, was the fully diluted valuations of all of these things relative to circulating supply, even today, never mind in 2020 or 2021, even today, for some of these tokens was 200 to 1, the fully diluted valuation versus the current circulating supply. So complete illiquid, excuse my French, dog shit tokens. And so when their balance sheet was all of the, $14 billion of assets versus, $7 or $8 billion of liabilities, there was a few questions that were, flashing bright red. It was, okay, what are the liabilities in? Because I assumed they were in dollars, but I was open to entertain the idea that there was in some form of crypto denomination, whether it's Bitcoin or Ethereum or Solana or whatever, right? It's possible, right? When Voyager went bust, Three Arrows Capital owed them a few $100 million in USDC and I think 15,000 Bitcoin. So there is precedence for, some form of denomination of liabilities in crypto assets. So that was the first question. The second question was, who's the lender? And I, poked around a little bit. Is it Genesis? I would really struggle to imagine anybody legitimately that would allow collateralized FTT tokens for loans. But we'll see. And the more that I poked around, and then specifically when Caroline, the CEO of Alameda, posted, well, I guess CZ called the bluff, right? CZ said, all right, we're dumping. And it was like, okay, well, let's see if you have 500 million to absorb. But then she tweets out, we'll buy all of your tokens for $22. And as you pointed out in your podcast last 2 weeks or a week ago, why would you ever draw your line in the sand if you're interested in buying this? Like, I'll buy all your Bitcoin, Safe, if you're a seller, but you have such a fat bag of Bitcoin that you might dump the exchange rate. Maybe Bitcoin's not a great example because it's much more liquid, but you know what I'm saying. And if I'm an interested buyer, right, like crash it to zero. Like, I'm interested in buying this thing. I don't care. Like, I'll buy it all. And she said, hey, CZ, we'll buy it all at $22. And this is, Safe, I swear to God, this is the first time I've ever in my life looked at the chart of FTT. I go on TradingView, type it in, click, put it in log scale and look at it from 2020. And I was like, oh my God, these guys are levered against their token. Because you look and the thing has never, I put a volume profile on it and the thing hadn't exchanged $10 worth of tokens in spot markets under $22 in its entire, I mean, they scam pumped it up, obviously. And then the entire 2021, 2022 run, it had never touched below $22. And that was like another kind of like aha moment. It's like, oh my God, they're levered. And so I start to pull up and I look at derivative markets just because I like to follow and analyze some of this stuff happening in Bitcoin. But I'm not one to go look at shitcoin derivatives. I could not care less. But I open up FDT open interest, and I look and I just see on FTX and Binance just massive amounts of open interest. And it was like, oh my gosh, never mind 500 million from CZ. Like, never mind if Alameda is liquid and it can absorb 500 million. They have to defend against hundreds of millions of dollars of speculative attacks, and they're levered. And the aha moment for me was, as $22 is just flatlining, and there's no obvious buyers, and it's obvious that they're deploying capital, because you can see on chain Alameda is taking all of its wallets that they're labeled, like they're literally labeled, and they're pulling them off all these third tier, these bucket shop exchanges where they're supposedly market making, and they're withdrawing all this liquidity from these. Never have I heard of these yield farm protocol things, and they're sending it to FTX. And I was like, oh my gosh, they're defending $22, and it breaks, and I see, I think it was like $100 million of open interest on FTX wipe, and it was like, wow, they're not levered via a hedge fund or via a collateral agreement with Genesis. They're levered against the solvency of FTX itself. Holy crap. And so we like, just like an hour before, we put out to Bitcoin Magazine Pro subscribers, and it's, we have a list of about 17,000 people, like, get the hell off FTX. And we didn't, like, legally, we didn't want to be like, they're insolvent run, but we said, like, hey guys, where there's smoke, there's fire, get off. And we held the spaces and everything else, but it was clear at that moment to me, it was only questions going in, right? Like, I had no definitive answers. What's their liabilities? Who's their counterparty? I don't know. But it increasingly became clear that they were leveraged against their own native exchange token with no natural buyers, that's supposedly worth billions, that was undergoing a speculative attack. They were leveraged against the solvency of their own exchange. And it was actually just quite amazing to see the cognitive dissonance of all of this unfolding, billions of dollars flowing off of FTX, and a lot of crypto people saying, no, I trust Sam.
Yeah.
It was just wild. So I think that's the TLDR.
That was really the most shocking thing for me. And in fact, in retrospect, I think another really shocking thing is why I never trade, and I definitely don't trade shitcoins, but I think not shorting FTT at that point was a very, very, very silly mistake, because it was very clear this thing is going down and it's going to zero. There's no way, because as you said, I think on your thread you had that the whole thing was worth, what was it? Yeah, the whole thing was $3.3 billion is the market cap. On their balance sheet, it's 5.8. And then CZ had about $500 million. So off the market cap, 3.3, $500 million of it. So there's 2.8 of the market cap that's not CZ. And they are marked for 5.8. So they've marked it for more than 100% of the non-CZ float. More than 200% of the non-CZ float is what's marked on their balance sheet. So there's no way that they won't defend it. So it was clear that this thing was falling apart. But even, and it's not clear to me why I wouldn't have, looked into how to trade these shitcoins and how to short them. I have no idea how to do it, but I should have really looked into it. But what was even more shocking was watching people just, even as this stuff was coming to light. In particular, I was pretty amused by the journalist at the Block magazine, which is a shitcoin industrial complex mouthpiece that is always out there telling the world about how great shitcoins are. And these people, they've spent quite a bit of time attacking Bitcoiners and talking up shitcoins and saying the Bitcoin maximalists are dead, Bitcoin maximalists are ridiculous, nobody listens to Bitcoin maximalists. And they were out there, even as all of these revelations were out there, the journalists in that place were saying, there's a 0% chance that FTX is going to go down. There's no way. And they were so shocked at it happening. And it's just, what's amazing for me is, why would you be so confident about this? What is it about this guy that inspires confidence? The entire story, as I discussed in the previous podcast, the entire story is so shady from A to Z that it's really strange why you would have any confidence in any of this stuff. But I mean, as we said with all of these things, if you have money riding on somebody, you really want to believe. And you are the most dangerous person to yourself, because nobody can fool you as effectively as you can fool yourself. So be very careful out there.
Yeah. I mean, it was not like there was things that were said about SBF and certainly the story was a little questionable. Like, there's 1,000 derivative bucket shops, right? I mean, people essentially just copied and pasted the BitMEX model of spot markets, derivative markets, non-KYC things where they, it's all the same interface. It's all for more or less the same, liquidation engines, like maybe some at the margin innovations here, but it's really like, the established players went out because, liquidity, like for instance, Binance, right? It's the most liquid, it's the most trusted, it's been around, like say what you want about all their shitcoins pairings or whatever, but like it's somewhat of a winner takes all dynamic. And I'm spending every day in this space just kind of monitoring what's happening, and FTX rises out of nowhere. And everybody's broken. They're buying Super Bowl ads, and they're buying, and they have all these major investors. And then, everybody in the industry is decimated post Terra Luna, UST, Three Arrows Capital. And they're saying, we're going to bail everyone out. And it was like, okay, I don't know how you guys have so much money, but apparently your hedge fund's cleaning up and all this other stuff. And, you probably pumped and dumped a lot of these tokens. Okay. I guess, but I'm skeptical. There was no, and say funny enough, I received just via, I'm chatting with some anons on Twitter, and I don't even know these guys' names. They're literally just like, freaking animal cartoons or whatever. And they're saying, like, I'm talking to them. I'm like, what do you think about FTX and SBF? There's some weird stuff going on. Why do they have their hands in all these bucket shops? And I get a DM back and it says, you're starting to notice, huh? And it was a deck. It was a deck of 2019. There was no name on it, but it was literally, and this turns out it was the Alameda pitch deck 2019. And it was literally a Bernie Madoff-style Ponzi. And I don't know if I posted it a couple of times. I don't know if I shared it with you in the notes, but if you can pull this up, it is an absolutely unbelievable document where they, during the 2018-19 crypto bear market, when Bitcoin and Ethereum went from 20,000 to 3,000, each went from 1,400 to under 100. And it wasn't a straight line down, remember. It was an extremely volatile bear market with plenty of bear market rallies. And these guys, they averaged 110% annualized returns, and there was no drawdowns in their P&L and their equity curve. And they said, we offer one investment product, 15% fixed rate loans. These loans have no ability to lose money. We fully guarantee no losses on these loans. And we can take up to 100 million or 200 million in size. And I immediately, and because I've done my homework, I didn't watch Bernie Madoff or see the 2008 financial crisis happen, but I've done my history, I've done my reading. I was like, I was like, there's no way that this is real. This is someone trying to kind of attack Alameda or make something up and damage your reputation. Never mind the fact that there were spelling errors in the deck. So I sent this to a couple people that I thought should see it, but I was like, this just has to be fake. There's just no way, because if it's real, I sent this to some people that I thought should see it with some FTX exposure and whatever. I said, hey guys, I don't know where this is from. It looks extremely fake, but if it's real, Alameda Research is running a Ponzi scheme. And I didn't post it because these guys were, the biggest exchange and the biggest hedge fund remaining. And from a reputational standpoint, I don't want to put something out that's so obviously fake that it damages my reputation. So I just kind of filed it away. And as this whole thing's unfolding, and as I do more digging into, the start of FTX and the start of FTT, it was clear that FTX and the launch of FTT was just a way to keep the Ponzi going. And you actually saw Suzu in 2019. He posted the slide deck or the pitch deck of this Ponzi scheme they were running, and goes, oh, these are the same guys that are trying to start a BitMEX competitor, with a bunch of emojis. And it was like, wow, like this was known that these guys, the crypto natives, really, these guys were running a Ponzi from the start. And it's just unbelievable. It's amazing that within 2.5 years of literally, the official story is, Sam, this MIT grad, just, with his spare couch money, arbitrages, this exchange rate, with in a country that has currency controls. So it's an inefficient market, and he somehow made $1 billion off of that, right? Never mind the fact that to make $1 billion on this arbitrage, you need billions of dollars to do it, right? Which is like, okay, the story was always fishy. The real story, and we're releasing this in the coming days, or maybe next week as the story keeps changing. So we have to keep rewriting some of this stuff as new stuff comes out. It turns out, FTX lost money in 2021, which is just utterly hilarious to think about. I more and more, I believe, and maybe we don't even have to go off this deep end here, but it looks like it was basically a money laundering machine from the beginning, in a way where, they were just funneling money to the political class and their own coffers, while keeping this kind of motion machine going. Regardless, it's just crazy that from running literally a Madoff-style Ponzi scheme to taking billions of dollars from supposedly sophisticated institutional investors within 2 years. It's just quite the story. And I mean, there is, I think by this standard, it's pretty obvious that the smart money isn't all that smart, and is duped quite easily, which is just fascinating.
Absolutely. Yeah, no, it's truly fascinating. And again, it's a reminder for people, like, just don't believe the hype. In fact, always question the hype. That the hype is another cheese in a mousetrap. Find the New York Times tell you that somebody's a genius. They're a bunch of idiots at the New York Times. They're a bunch of paid prostitutes, essentially. And so if they're out there calling somebody a genius, they got paid to call them a genius. And nobody benefits from paying people to call them a genius if they're actually a genius. Like, if you're a genius, you don't go around paying the New York Times to call you a genius. If you are paying the New York Times to call you a genius, then you're probably a crook, and whose business model depends on making idiots think that you're a genius. So generally, I mean, it served me very well in my life to think of the press, the organized press, the professional press, to think of them as an attack vector on your brain, and to treat them with extreme suspicion, because it's an institution that's built to get into your brain, and that's just an attack vector. It's out there for anybody who wants to lie to you. They know this is where you go to buy your Trojan horses. This is intellectual Trojan horses. That's what the press is. So you should treat everything they say with extreme suspicion. But, people don't like to imagine that the world is so ugly, and so they continue to experience the horrors. What are we going to do?
No one could have seen this coming.
Yeah, no one could have seen this coming. This is this is how you know that this won't be the last time, because people are just going to continue to fall for this because they don't want to believe that it's possible to foresee those things. So now the biggest news now in Bitcoin and crypto world is the GBTC and Grayscale and the digital currency group. What are your thoughts on that? This is unfolding as we speak, so we're recording today on November 22nd. What are your thoughts of what's going on there?
Yeah, I mean, I don't own GBTC. It's obviously a security. None of it is financial advice. I would really like to see, if I was an investor of the trust, I would really like to see them post the address. I think it's trivial to do this, or the address is, they have 630,000 Bitcoin in this trust. I think that the probability, and it's non-zero, but the probability of like wide-scale fraud, SBF-style fraud from the Grayscale digital currency group point of view is extremely small. It's non-zero, so there's risk. The real thing here is that you have 2%, you have a wrapped custodial Bitcoin product that trades, unregulated or traditional financial rails. So there's not the immutability, there's not the the transferability, there's not the portability of Bitcoin or the fungibility. Its use as collateral is far less advantageous, and that 2% fee, I mean, if you just put that out 10, 20, 30 years, right, that eats away at your Bitcoin holdings quite significantly. I mean, certainly you can maybe try to play this arbitrage opportunity, but I think the real question here, and this is what I've been asking, is Genesis is functionally, right, they have liquidity issues. If we go back to what we were talking about previously, mark-to-market functionally, Genesis is insolvent. And there's no one interested. You couldn't pay me $0 to buy Genesis loan book because it's not worth $0. It's worth negative, right? They have more liabilities than they have assets. And so the real question here is what's the digital currency group's exposure to Genesis or vice versa? And I think that I'm pretty sure that this could be, kind of in a similar sense of like FTX Alameda. There's some form of liability exposure between the entities or institutions. And so I'm kind of running some thought experiments in my head. And I think that GBTC is fine, aside from like the non-zero probability of fraud, right? And even then, it wouldn't be zero Bitcoin. There would be some amount of Bitcoin there. And the coffers, I would imagine, right? I would really, really doubt that they take all 600,000 Bitcoin and burn them somehow. But I mean, who knows? I think trust in this, the key point here is trust in this market has been, shattered, which is why the GBTC product is trading at a 47, or maybe it's like 40% discount now. I know that the discount closed a bit. I think it's interesting because if DCG is insolvent, based on, buying in a bunch of liquid private companies or buying shitcoins in 2021 and potentially financing the Genesis loan book that went bust. If they're insolvent, then they either have to dissolve this trust, which means liquidating the Bitcoin and returning it to its shareholders, which 600,000 Bitcoin would have quite the market impact. What I think is more likely if they're insolvent, and again, I have no idea, these are just kind of questions, is I would imagine that there would be someone probably in the legacy system that would come in and buy the trust, that would buy the product from Grayscale. And so, I mean, it's interesting. And I certainly, I really don't have interest, maybe just as a punt of a trade to buy GBTC, because, at a 50% discount to net asset value, I'm not even sure the math in my head. I think it would be, it would be like 100% upside relative to what you put in if the discount closed and we returned to net asset value. But I have no interest in holding this thing for the long term. So I don't think it's like existential in any way. I mean, I guess the worst case scenario for the market would be that they are insolvent, they wind down the trust and then liquidate 600,000 Bitcoin. I imagine there'd be an OTC buyer that would just kind of step in and buy it up out of the discount, but I don't know. So yeah, I guess that's my kind of preliminary thoughts.
Yeah, and I think you're correct in that the GBTC is the cash cow for digital currency group.
It's money.
It's just money. It's sitting there, and that's because it doesn't do any yield. It doesn't play stupid games, so it doesn't win stupid prizes. And then all the other idiotic bullshit that they do with all of their lending portfolio, or the massive amount of shitcoins that Barry has foisted upon the world. I mean, Barry's really done a lot of shitcoining, and he's promoted a lot of shitcoins and constantly brags about how much he puts them out there. And they've done a lot of lending to what are now clearly insolvent institutions. So that stuff is all falling apart. I think it seems to me like what they're trying to do is somehow leverage the fact that they have their GBTC in order to try and get financing to keep the rest of their toxic portfolio from making them insolvent. But it's not clear whether they're going to be able to pull that off, because what else do they have that's worth anything other than this? I mean, it's going to go down as I think an excellent lesson in how just mismanaging your Bitcoin strategy by engaging in shitcoins. I'm sure it looks great on the way up. You're shitcoining and you're chasing yield and you're doing all of those things. But now on the way down, only thing you have left really is just the simple Bitcoin holding model, and it's quite shocking. Like if they just kept that, and they could have kept CoinDesk, so that they can buy the good press and shape the narrative around this. But yeah, just run GBTC and CoinDesk, and they'd be in a lot better shape, I think, than what they're going through right now.
Yeah, I mean, obviously hindsight is 2020, but yeah, exactly. Yep. Yeah, I mean, it'll be interesting to see if they can survive. I mean, GBTC, like you said, is a cash cow. So 630,000 Bitcoin, 2% of net asset value is liquidated every single year in perpetuity. Run those numbers, that's about 30 Bitcoin a day that they just peel off and sell in the net fees. So, it would be a real travesty on Barry's end. I mean, I have no position here. I have no horse in the race. But if Digital Currency Group is forced to sell this product to another institution or player or whatever, it would be quite the fumble. Never mind if they have to liquidate it, which I don't think they will. But it's certainly an interesting case study into shitcoining and lending and how it can all go wrong.
Absolutely. All right. So now all of this is, I mean, we've been on for quite a while, but this is really appetizer for the main course, which is the biggest shitcoin scam of them all, the shitcoin scam of the world. the US dollar and the treasury market. So one other, you haven't just called all of these crypto Ponzis before they fell apart, but also, I can't remember when that tweet was, but there was a tweet in which you basically said you looked at the bond market and you posted that clip from the Big Short movie, which is a sell everything. And really, that was incredible timing because that exact point you even plotted on the chart a few months later. The bond market just took a giant nosedive after that. I think it was in the summer of 2021 or late 2021.
Yeah, it was around November
21.
It was funny enough because the analysis lined up and pointed to, but that original post was more so like, I mean, I've posted a lot of threads and everything else, and sometimes they do really, really well. And that one is more so just like posting my thesis out there with kind of like a video shit post, and it really blew up. And in hindsight, the long bond was down only from that point. Really, I think it was just like most of these things I approach from a math perspective. People get caught up in the political narratives and what this talking head is saying and what this talking head is saying back. For me, it's like, okay, let me just this is the reason I love Bitcoin, is because strip it all back. I don't care what you say. Let me see the math. And the math behind government bonds that were yielding 1%, 2%, while inflation was going from 2 to 3 to 4 to 5 to 6 to 7. And it was clear that there was a structural imbalance in inflation and really like an energy deficit and all of these things that I mean, you've talked about on your podcast ad nauseum. And it made no sense to me why anybody would finance the government or finance anybody, like junk bonds yielding below inflation, right? That was a reality earlier in this year. Junk bonds had a lower nominal yield than inflation. And the bond market guys will tell you, well, no, you're using the trailing 12-month inflation print while also using the yield on a 10-year treasury. That's not technically correct. And it's like, okay, we can get into the semantics of it all if you want to do this, right? But you're telling me that inflation expectations are for the forward next 5 years are only 2%. And I'll tell you, go back to 2018 and look at the forward at 5-year inflation expectations. And guess what? They were wrong. And so like this whole thing of like, well, the TIPS market, which the Fed owns 25% of, is our gauge for inflation expectations. And so the bond market's always right, and the bond market's the smart money. And here I am saying, well, no, that's wrong. And it's wrong because if you're financing the US government, never mind the fact like debt levels are at all-time highs. The only way to go out of this, and the funny thing is they literally scripted this. The Fed says we need more inflation, we need more inflation, we need more inflation. The IMF has wrote countless papers saying, yeah, mathematically, there is no way out of this debt bubble except a decade plus of financial repression. And at the same time...
And by financial repression, to just clarify, you mean by financial repression, what they mean for that is that we're just going to destroy the value of your savings, and so that we can reduce the amount of financial liabilities that the government needs to pay, basically. Inflation.
Exactly. Financial repression in normal speak, in non-bureaucratic central banking speak, is simply inflation higher than yields, inflation higher than the risk-free rate. So really what it means is creditors get pillaged of their purchasing power, but not only creditors, savers, right? Savers and creditors both lose in real purchasing power terms. And you can use the CPI gauge, you can use a barrel of oil, you can use, like you always talk about, especially in the fiat standard, like, well, yeah, you can change your CPI gauge to go from a ribeye to a Beyond Burger, right? and even then there's still inflation, but like it's very clear to anybody that can logically put things together that the average standard of living, or anything that you'd really want in the world over the last 2 years, 5 years, 10 years, 20 years, is becoming more expensive in paper dollar terms, right? Like it's extremely obvious. And obviously technology has to some extent muted that, or maybe even reversed that in some levels, right? Where, an iPhone has all the information at your fingertips and it only costs $1,000, right? So there's that's pushing against the trend. But really for me, the bond market thing, the bond market call, and saying like, hey guys, I don't care what it does in nominal terms. There's still people out there, funny enough, that think, and who knows, maybe it's possible that we're going to see such a big deflationary bust as a result of this tightening cycle that the bond market is going to return to the zero lower bound and the long bond is going to go into negative territory, right? So the people that are, have been long bonds all the last 2 years are saying, don't worry, guys, the deflationary bust is coming, and we're right, we were just early. But even then, this is what I tell the bond bulls, that I'm just confused. Even if your long bond appreciates in principle because the yields return, collapse and go back to zero, in purchasing power terms, you can use the CPI, you can use M2, you can use energy. I don't care. You can use equities as a denominator. Up to you. In purchasing power terms, the long bond has generationally topped. And what does that mean for the financial industrial complex? And there hasn't been a whole lot of good answers as to what that fundamental shift means, because for the last 40 years, post Nixon shock, and that initial inflation spike in the 70s, Volcker comes in, raises rates to 20%, and since that point, the debt, the demographics, the technological revolution that we saw with the internet and the semiconductor revolution, all of these things have been disinflationary. Globalization, disinflationary. The demographics, disinflationary. And now we have a giant energy deficit. We have a unipolar world order that's seemingly reversing. Maybe globalization hasn't peaked or isn't fully reversing, but there's a lot of signs that are pointing to, this U.S. Hegemony world order not collapsing, right? But fraying, definitely fraying at the seams. And so what happens if we go from a period of, disinflation of 2% compound annual growth rate in purchasing power to 5% or 6%? What does that mean for this $200-300 trillion bond market, these global debt markets? And I really, it's amazing that not many people have, one, asked the question, and two, come up with a response as to what the solution is, or what the ultimate result of all of this is, right? Here's an awesome stat, and then I'll hand it back to you. There's been 2 times in history, and I guess since I've run these numbers, bonds and stocks have both rebounded a little bit, but there's been 2 times in history that both stocks and bonds have been down in a year at the same time. It was, and both of these instances, they were both down 20% plus year over year. It was 1931, I believe, and 1969. And I was looking at these numbers and I was like, wow, that's really fascinating. This only happened 2 other years. And the next morning, I was looking at it again, and I was my mind just was blown, because I realized 1931 and 1969, the 2 years where stocks and bonds have both declined 20% year over year in tandem, within 24 months, the U.S. defaulted upon its debt. 1933, FDR, 6102, they seize your gold, they immediately revalue gold higher. They devalue the debt in real terms. 1971, Nixon shock. They say, nope, sorry France, sorry nations, we're not redeeming your dollars for gold. And those were both implicit or maybe explicit defaults, right? The paper of dollars that you thought you had were for gold, nope, done, devalued. Well, here we are, safe, 51 years after the Nixon shock, 51 years into this global fiat experiment, where there's no base level collateral. There's no gold underpinning this fractional reserve Ponzi. Maybe not Ponzi. Maybe that will discourage some people from the message that we're putting out here. From this fractional reserve lending system, there is nothing underpinning the system itself except the debt-based collateral. And so when you have stocks and bonds fall down 20%, when you see the fastest tightening cycle in recorded in modern history come about, interest expense just up and to the right, that hasn't even been really trickled through the global economy yet. What are we going to do about the debt? How does the debt get defaulted upon? Because mathematically, it's coming. And the solution that I come to is that there will be no explicit default here, right? There will be no explicit, okay, we're not paying you back. The default will happen, the devaluation of the currency itself. And where do you hide? Do you hide in government bonds? Do you hide in equities? Do you escape to, JPEGs or Beanie Babies or houses or Luna? Or do we have an engineering solution to all of this? And I I kind of lean with the latter.
Yeah, no, I agree with you, obviously. Yeah, and I think this is really very astute because the average fiat user does not think that a U.S. government is something that can default. Like default is something that happens to private companies, individuals, but the government has never defaulted and will never default. And the average fiat user does not even know that in 1934 gold was confiscated and that in 1934 gold was revalued. You know, in 1930, 1 ounce of gold was worth $20.67. By 1934, it was worth $35. And in 1971, it was supposed to be $35, around that range. But then when they closed the gold exchange window and central banks could no longer redeem gold from the U.S. central bank, within 9 years the price of gold went up to 1980. In 1980, it went up to about $800. So it was a 40% devaluation of the dollar in 1930s. And it was, if you want to measure it against the gold, which, isn't entirely accurate, isn't entirely fair to say, but it was a 95% approximately devaluation from bottom to top, or from top to bottom, 1971 to 1980. Obviously it was a little less, it was a lot less than that in real terms. Things got more expensive, but I wouldn't say 20 times more expensive. Well, maybe, but still, there was clearly a massive devaluation of the dollar in both cases. And I think it's extremely telling. We've already had significant devaluation over the last couple of years, but the question, I think, is, as it seems to me that you're suggesting, is that we're going to be getting more, because there's just no other way out of this except for more repression and devaluation. Because, as you said, there's the stock market is collapsing, or at least dropping, and when the bonds are dropping as well, there's no exit. Now, I'm curious here, what is it exactly that made you think that we're going to be getting such a giant drop in the bond market specifically? So, because historically, when you get a recession, the stock market is in trouble, but the bond market does well. And so I think most people were caught by surprise this year because they'd imagined, all right, well, interest rates will rise, so bonds will decline, but the flight to safety is going to prop up the bonds to some extent. People are going to dump their stocks and buy bonds.
Yeah, I think it was more so realizing that with this kind of visit to the zero lower bound, and I didn't play this masterfully in a hedge fund and make billions of dollars shorting the treasury market. I wish I did, and that maybe with a few more years of financial or life experience, I could have been there. But I mean, more so, it was kind of my first cycle in the captain's chair. So I was learning on the fly as well as kind of commentating on the fly. I think I did a pretty good job of it. But really, what made sense to me was we were at the zero lower bound. What does inflationary spikes in the past? What does it mean? And we've seen this risk parity trade for the last 40 years of like you said, in a recession, stocks fall. Credit conditions tighten, the real economy falters, and bonds, due to the Fed cutting the cost of capital, and more so, being like this quote unquote risk-free trade, the long bond gets bid up. And so, in 2008, the long bond was up 20% or something. But with a long bond, with interest rates at 1%, and inflation accelerating, it was clear to me that it was, risk parity as a trade, or at least, maybe temporarily, maybe it returns with a vengeance. I doubt it in real terms, but it was clear to me that we were going through some form of, a stock bond correlation crisis, in the sense of, if the long bond's selling because of these inflationary pressures, structural inflationary pressures, then, this was exacerbated by, I wasn't predicting the war in Russia and Ukraine. But that happened. And I said, okay, what are the smartest people on this topic in the world saying about this? And they were saying, oh my God, this is stoking the flames of an energy deficit. This is going to result in all of these supply chain issues and all of these commodity shortages. And so that was like, okay, well, inflation, guess what? It's not transitory, guys. And so, I frequently referred to the most important chart of finance as the 10-year treasury yield and the Fed funds rate, or the inflation, the year-over-year CPI print. And it was clear, right? Like, whenever you have like the real bond bull market, the 40-year secular boom in asset prices was a result of inflation below the cost of capital and interest rates going in a secular downtrend. And if that reverses, what does it mean for the average investor in their portfolio? And so as that unwound, I think, the bonds sold off, the cost of capital raised, and people, continued to buy the dip without realizing like what was fundamentally happening. And it was really, right, energy, the structural energy deficit repriced the discount rate. And that repricing of the discount rate repriced asset valuations across the board. And here we have Bitcoin, right? There's no cash flow, there's no earnings, but fundamentally Bitcoin. And the reason I pay attention to the macro and comment on the macro stuff, as well as the shitcoins and everything else, as a Bitcoin focused analyst or investor or accumulator, if you want to say that, is because that all of this makes a difference in the kind of the liquidity tide, if you want to think of it, right? And so this everything asset bubble was turning into, or is unfolding into an everything asset bust, as this discount rate ratchets up higher, and as this house of card valuation bubble collapses. And that sounds very overly dramatic, but I think just if you look into the history of financial markets, the 10-year treasury, it's been bid up a little bit, but the 10-year treasury hadn't had the year that it had in 2022 as of a month ago in the history of the world, in the history of modern financial markets. And so like that is the global reserve asset, right? The dollar is a global reserve currency currently. The global reserve asset is the US Treasury bond. And when that is having its worst year in recorded history, it's pretty wild to me that it was seemingly underreported, right? Like you walk around and the average person, which admittedly makes sense, but the average person has no idea what's happening. And it's this once in a generation, sudden repricing of the risk-free rate, the risk-free asset. And I think even after this dramatic repricing, what's going to happen is a gradual bleed, a slow death of the hundreds of trillions of dollars of purchasing power, of value that's nestled itself in fixed income markets because of this financial repression that's coming, right? I said in 2020, as I was kind of formulating my thesis, I read your book, I read all of Dalio's books, I listened to hundreds of hours of podcasts trying to piece together this puzzle, and came to the conclusion that hyper Bitcoinization as a phenomenon, as a trend, is the biggest wealth transfer ever from fiat creditors to Bitcoin savers, to hard money accumulators. That's what's happening here. And people can't see it because, Bitcoin's hyper volatile. And what does Bitcoin have to do with a bond? But what's the process that's taken place for the last 2 years? I mean, maybe you could say the last 10, but specifically post-COVID, the process that's taking place, as the long bond went to zero and has since sold off in a pretty meaningful way. This is a process, the biggest wealth transfer that we've ever seen. That's still in the very early innings of a transfer of purchasing power from fiat creditors, people that lend their money to the government or to corporations or to individuals, to Bitcoin accumulators, Bitcoin savers. And I think that thesis is despite all of this, despite all the Ponzi blowups, despite Bitcoin 80% from the highs, is completely unchanged. And I have actually more conviction in this thesis than I have ever had before.
Yeah, well, I agree with you, and I think there's an element here of you're very young, you're a college dropout, and so there's obviously the tendency to say, well, you obviously don't understand how markets work, young man. But I think there's the case to be made that precisely because you're young and you're a college dropout, you're more likely to be the child who says, the emperor has no clothes, because everybody else has been so conditioned to grovel in front of the emperor that they cannot ever even fathom the idea that the emperor is naked. But, one day he might be naked. One day he might be naked, and everybody who's spent their entire life perfecting the art of groveling to the king is not going to be able to call out the nakedness. And I think your thesis is very compelling, and I obviously share it. And I think what you mentioned is that we've had this one thing I want to pick on. We had this very long time where the cost of capital was below the inflation rate. And people thought of this as if it's just the new normal. And again, everything that we said during the discussion so far, I was saying it, talking about the crypto markets, but with an eye of projecting to the fiat market. You know, the normalcy bias that people have. Well, it's always been like this. Well, Luna was always going to be paying off. BlockFi is always going to be working. Celsius has worked for years. It's not different from the normalcy bias that people have when they talk about fiat markets surviving for 40 years. Just because things happen slower in the analog world doesn't mean that they never happen. We've already had 2 defaults in the last century by the US government, and arguably a third one as well in World War I when they suspended redemption of gold. This is, I think, if you want to believe that the fiat system as it exists is just the pinnacle of human achievement forever, then you would think, yeah, we're always going to get lower interest rates than inflation, and everybody's always going to be able to borrow, and things are going to always work out like this. But I think there's a very compelling case to be made that this was the boom in the Luna cycle. This was the point where everybody was stacking on debt, and this is the key thing. Yeah, the fact that the cost of credit was so low meant everybody was borrowing. Individuals are borrowing, governments are borrowing, corporations are borrowing, and as a result, public debt and private debt has reached levels that are completely unfathomable before. And just because they continue to grow, and they've continued to grow for 40 years, doesn't mean they're going to continue to go for another 4,000 years. There's going to come a point when likely the debt is going to be unsustainable, or the inflation is going to catch up, or the interest rates are going to drop, or the interest rates are going to rise above the inflation. Something's going to give at some level. And I think this is where looking at the Luna example and looking at Celsius and BlockFi is quite instructive. Like, once the music stops, it's not like they can just manage to keep this going. Well, now you have all of the borrowers that are borrowing at a much higher interest rate. What happens to them? Well, they're going to get a lot of insolvencies. Can you maintain this wave of insolvencies in order to keep inflation down, or are you going to take the inflation hit? One way or the other, the creditors are not going to be coming out of this on top. I think this is really the powerful point that you make. Like, either you're going to get your credit, the money that you've lent out is going to get significantly devalued, or the people that you've lent to are going to go bankrupt. You raise interest rates, they go bankrupt, you have a solvency crisis, your credit is wiped out. You drop interest rates, then you have an inflation problem, and yeah, you do get paid back, but you get paid back in devaluing currency. So I think I agree with you on this. I think fiat world is nowhere near prepared enough, and I think it's full of people that are just incapable of seeing the naked emperor.
Yep. I mean, it's pretty wild to think. I kind of, as a mental framework, think of like these 2 distinct outcomes of the right tail, or maybe this is the left or the right. It doesn't really matter. The right tail is like, hyperinflationary, credit boom, right? And then the left tail in this fiat system, are really in a Keynesian economic system, is deflationary bust, crash. Money supply is destroyed, economic devastation. A deflationary bust, right? Asset bust, and unemployment, all of these things. And the Fed monetary policy specifically, not even really the Fed policy, like the fiat system, this fractional reserve system. It's the whole thing is attempting to, whether it's backed by gold or it's pure fiat based, the whole thing is attempting to toe this line, right? Of like, the Ray Dalio refers to this as like the Goldilocks phase of like, we're kind of, credit is expanding, and there's this harmony and there's this unison where everything's working out well, and there's a balance of creditors and debtors, and asset prices aren't booming too high, employment isn't getting too hot. But the reality is, as we tack on all of this debt for the last 40 years, right? As debt levels have increased, as interest rates have declined, as asset valuations have boomed, what you have is this the volatility of these 2 distinct outcomes of, and we saw this really ratchet up post 2020 of hyperinflation, like these tail risks, which people probably, most regular people or people in finance, assign as 0% or 0.1% probability of these devastating things happening. These 2 tail risks of total deflationary bust collapse and hyperinflationary, asset bubble, or not even asset bubble, but hyperinflationary currency crisis. And you can apply this to the US, but really the entire world, and actually the entire world is much more vulnerable to this. Those distinct outcomes, because of the debt burden, is more volatile and whipsawing back and forth than it ever has before. We used to have these credit cycles that are, once every 10 years, once every 8 years. We had the longest bull market in history post-Great Financial Crisis. Zero interest rate policy, quantitative easing. COVID happens, and we don't even have to dig into the fact that the repo market blew out in 2019. The Fed started expanding its balance sheet and cutting interest rates before 2020, and COVID was somewhat of a convenient excuse to print trillions of dollars. We don't even have to get into that, Saif, because that's a rabbit hole in itself. But after this, buying corporate debt, injecting tens of trillions of dollars, stimmies, PPP loans, just money printer go burr, buying $120 billion a month of mortgage-backed securities and treasury bonds, valuations and equities at all-time highs, bond valuations just ridiculously low, junk bond levels below inflation, all of these things, right? It was, people were saying, even Ray Dalio, these really smart guys, cash is trash, which it still is in the inevitable long game, the inevitable end game. But the Fed says, all right, guys, we got to slow down. We have a currency crisis on our hands. We're going to tighten the belt up. And now they're raising rates. Treasury bonds are selling off in a massive way. And there's these monetary policy lag effects. And if you really just go through the math from a treasury level, from a government standpoint level, never mind the private sector, right? Where you have basically military interest expense. Probably make a few more points here. Is that when you're looking at and this is nothing that you don't know, but I really like the Luke Gromen thesis of, if you just look at the government spending, and the government is an enterprise just like anybody else, and you look at their basically their expenses versus what they take in. Well, as a result of this everything asset boom, they had also a bubble in tax receipts, a bubble in income, government income, right? The tax base is the government's income. But now, right, you have the military budget, which isn't going away. The military is not going away. The military is actually the biggest consumer of petroleum in the world. What has happened to energy prices? Entitlements, whether that's Medicare, Medicaid, Social Security, well, that just had a 10% increase in cost of living adjustments, COLA, right? And so as inflation spikes, the entitlement balance continues to grow. And at the same time, your interest expense has gone from, say, 1% rates to 3.5%, 4% rates. And I think about 50% of that debt is rolling off, and that number may or may not be correct, but a large amount of this debt is rolling off in the next couple of years. So the reality is the government, right, the Fed is ultimately, because there's no natural buyers of this debt at these interest rates, the government is the Federal Reserve is going to have to, come up with some word jargon facility in, whether it's 12 months from now or 18 months or maybe sooner, maybe something breaks like it did with the Bank of England. And they're going to have to come and finance the US government and print money, right, to maintain this credit-based house of cards. Because the government, similar to like a private enterprise, the government is functionally bankrupt with interest rates at these levels, because people, they don't understand, or maybe they do understand, but people that are saying, the Fed can raise rates and this is sustainable. And a lot of people in 2021 said the Fed can't raise rates, and we're proven wrong. But I think more so they were saying the Fed can't raise rates in a sustainable fashion without bad things happening, was really what was lost in the nuance. And we're in the early stages of this. But what's going to happen when there's a large scale recession and one person's like spending is another person's income? I mean, this is basic economics, right? And you just see this the same way that you see kind of reflexivity, to borrow a George Soros term, on the upside. You see this same thing of deteriorating liquidity, credit conditions, balance sheet impairment, income, discretionary spending to the downside. And what does that mean for, never mind the private sector, but the public sector? And that's where I come to the conclusion that they're in this fiat system, right? To maintain this credit-based system, there needs to be perpetual credit expansion to sustain itself, right? Because I lend money into existence as a commercial bank, and that money has an interest rate. And so how does that interest get paid? Because the reality is, if you know how this fiat system works, as you do, Saif, you lend money into existence and it needs to be paid off plus interest. If all of the debt is paid off, there's zero money supply. Money is created through lending in the system. And so in a world where the interest expense, the debt burden is as high as it's ever been, and interest expense just tripled, right? what's going to happen here? And no one's asking these questions. And the reality is there's no other alternative from a mathematical perspective on a long enough time horizon. I don't care about the next 3 months. Hell, I don't even care about the next 3 years. I mean, I think things are going to get crazy before this, 3 years from now. But never mind. Like people are so short-sighted with all of this. Yeah, the Fed has raised rates for 9 months, but tell me what happens in the next 18 to 27 to 60 months, and I'll tell you, it's going to be more of the same. It's going to be, it's going to be some crisis, which requires an unprecedented amount of stimulus and fiscal and monetary response, and the end result is the paper dollars in your bank account or in your CBDC wallet don't buy you as much as they did the day or the year before. And I think the beauty of Bitcoin, the beauty of you, writing these books and having these podcasts and, us posting on Twitter and literally banging the drum about the same message over and over and over again, as nauseating as it is sometimes, is it's just math. And, in my opinion, there is no alternative to Bitcoin in this world.
Yeah, I think one of the hypotheses of the fiat standard is I look at the energy market in the 70s, I look at the food market in the 70s, and you see that the way that inflation was managed in the 1970s. So on one hand, they did raise interest rates, they did bring it down. Worth noting that the reason that they could pull that off in the 70s was that the debt burden was nowhere near as big as it is right now. So you could raise interest rates then, and the government would still comfortably remain solvent because they had far less debt compared to their expenditure as they do today. But I think we were doing some back of the envelope math with James Lavish on the Twitter the other day. And I think it's at around, I can't remember, but it's at around 8% or 10% or something like that. No, I think it's 14%. It's at 14%. If they raise interest rates to 14% currently, then the US government is insolvent. They can't pay off 14% interest rate on their bonds. And, that number continues to drop with time because the deficits continue to pile up, the debt continues to grow, and so the interest rate that they can sustain continues to decline. So they still have some runway, but they're running out of runway. In the 70s, they had a lot more runway. But the other way in which they brought inflation down is not just raising interest rates. The other way, I think, is that they taught you to have fun staying poor. This is, I keep going back to this, and I keep pounding this drum. And when I first wrote the fiat standard, people used to laugh at this idea that, this guy wants to convince you that bad food is caused by fiat money. Stupid Bitcoiners. They think everything is about their stupid orange coin. Well, fortunately for me, on the same week in which the fiat standard came out, which is exactly a year ago, in the same week, the Federal Reserve of St. Louis published a tweet thread explaining to you why you are better off eating soy turkey. Get a turkey made out of tofu rather than regular turkey, because it provides you with more proteins % or something like that. And nowhere in the Fed's mandate is be Betty Crocker included. So why are they so interested in getting you to eat this food? And why is it that every single time that any of these big fiat beneficiaries get into the discussion of food, it's always to extol the virtues of cheap industrial crap and to tell you that stuff is better than the food that you want? I think we're going to see more and more of this, and I think the lockdowns are a preview of the real way to fight inflation. So on the one hand, raise interest rates and bankrupt half the businesses and potentially bankrupt the government and destroy entitlements and do unspeakably unpopular things. Or on the other hand, tell people you getting to drive a car is ruining the weather and destroying the earth and boiling the oceans, and you eating meat is boiling oceans, and so therefore we're going to have to lock you up and feed you processed cattle feed, basically, and then that's going to bring inflation down. So I think we're going to see more and more of this. They're already talking about climate lockdowns, and this is going to be a way in which they're going to buy themselves a lot of time and possibly extend this. And I think it's a hugely effective way of fighting inflation, because if people can't leave home, people can't spend, and if people are just stuck consuming digital goods, highly industrialized food, inflation is solved.
Yeah, it's interesting. I think the whole debate about inflation and the calculation and what the Fed comes out and says it's transitory, or before that they said we need more. It's interesting because I think the whole premise, I think you've said this multiple times, the whole premise of, and Michael Saylor actually was really loud and championed this point quite effectively. Like, inflation is a vector, and the fact that we have this one statistic calculation, which is an ever changing basket assembled by 100 PhDs in some lab about this is the official inflation rate, when the reality is that my basket of goods and services is entirely different than yours or the next person's. And so to say this is the rate of inflation, when inflation is entirely a monetary phenomenon, right? Who knows what the prices of things would be? Who knows what the prices of houses, or the prices of healthcare, or the prices of a car, or even an iPhone, right? Which, like, if you think about what the iPhone gives you today, it's a calculator, it's a telephone, it's a library at your fingertips, it's a television. What would that be worth in 1980? And never mind the network effects that come with it and the fact that no one else would have a technology. But what would that be worth 40 years ago if you could have every all the information at your fingertips? And the reality is it would be worth a gajillion dollars. Like, it's incalculable how much it would be worth. And so measuring inflation with this arbitrary gauge and saying this is the official rate, and for the last 4 years, as we talked about, we had disinflationary because of globalization and because of all of these emerging markets industrializing the inflation rate, even though you could look at M2, which some people would say is flawed metric, or you could look at asset valuations or anything else, the stock market, bonds, the price of real estate, and it was going up by 12% a year, compounding at 10% a year, and inflation was only 2%. And people thought, like you said, that this Ponzi, this perpetual motion machine, could go on forever, and that this debt-based wealth creation was somehow a sustainable thing that we just discovered, right? Like, this is the new normal. It's that your stocks go up by 10% a year forever with minimal volatility, and all you have to do is just passively index into a basket of equities to save. It's somewhat just it's crazy that so many people can't remove themselves out of this matrix of a system and look at it for what it is. And so now we have a small bout of inflation, and we see a 50% wealth destruction across certain assets, or maybe 30% is more accurate. At the same time that your purchasing power since 2020 has gone down by 20%. And so I think this next decade will be extremely telling. You're going to see plenty of propaganda, whether it's about climate or energy. And the sad thing, Saif, is a lot of people in my generation, I still live in the same college town that I left university from. People believe it. People believe the story. People believe the propaganda. It's a lot of people are going to be really hurt by this. I think ultimately Bitcoin will offer a life raft, but it's one of those things that you have to seek it out as a solution, because no amount of a Bitcoiner, yelling in your ear will actually make you, seek to understand this thing and for what it is. Never mind Bitcoin, but the system itself. People don't want to remove themselves from the matrix. They want to trust someone. They believe that these people have their best interests. When ultimately everything tells you it's the exact opposite, and that these people, whether it's some man behind the curtain or just a bunch of people in power that have their own incentives and their own self-interest, they don't care about you or your well-being. And that's like kind of the black pill, right? It's like this system that of trusted institutions and of central banking and government, and this massive basically centralizing force that we've seen throughout the last maybe 100 years, but if we're talking about the Fiat industrial complex since the Federal Reserve, or even before that, it's about trust. And the reality is that we now have this somewhat of an escape valve, I like to think of it as. And the more people that just voluntarily, peacefully walk away, there's no violence in this process. It's the most peaceful revolution we've ever seen, and that's what gets me so excited about it. Is that I don't have to violently protest my government when I can just voluntarily store my wealth in something that they mathematically can't steal. And I think as more people wake up to that, never mind the fact that it's just a natural self-interest of buying Bitcoin if you have a lot of capital. Bitcoin is a pure, like, you wouldn't be into Bitcoin if you didn't have your own interest at heart. Same with me. I could think you're the biggest scammer alive, and we both can own our own Bitcoin and can't do anything about it, right? And so that, Bitcoin is money built for enemies. And I think, like we talked about earlier, there's just the amount of people that have actually done their work, done the homework, not only on Bitcoin or crypto, right? But the reality of the macroeconomic situation, where we are, where do we stand in history, which is truly, we've seen it before, right? There's nothing new under the sun, but it's truly unprecedented to the scale and scope of the global fiat system, right? It's entirely a global phenomenon of a debt-based monetary system. And if we are, or maybe we've already passed the inflection point, where do we go from here? And I think we know the answer, like we've talked about, but seemingly no one, even the people in the know, have any clue.
Yeah, I think there's, as you said, the black pill of realizing this is just so pervasive everywhere around you, and everybody falls for it. But there really is the white pill, which is that, you don't have to buy into any of these Ponzis anymore. Because of Bitcoin, you don't have to be in Luna, you don't have to be in BlockFi, you don't have to be in Celsius, you don't have to be in FTX, and you don't have to be in your treasury bonds. And in fact, you don't have to suffer from inflation even. You can protect yourselves because you have access to a form of money that nobody can devalue. And this is like the liberating thing, and also the depressing thing is when you realize it's really people who bring this up to them. People bring this themselves because they're the ones who put themselves in these positions. And if you just snap out of it, you could have taken your money out of FTX before things imploded, but you wanted to believe that, clearly Sam is a genius. I think the same is true in other contexts as well. People just need to snap out of their own scam. They scam themselves into believing those things because they want them to be true. And in most cases, really, the driver of this is the search for the yield. People just want to believe that they're getting something from nothing, and that's the best way to get scammed. Like if you look at how con artists operate, you wouldn't get scammed if you weren't getting greedy. Somebody comes and tells you, hey, I've got this amazing deal for you, where I'm going to get you this thing at a much lower price than you would expect. So you get in on a scam thinking that you're going to be scamming others, and that's how they get you in most cases. And I think this is what a lot of the fiat people are going to realize, that they think of themselves as being the winners of the fiat scam, but you think you're the audience in the circus, but you are the show. You're the main draw.
Great way to put it.
Yeah. Well, Dylan, this has been fantastic. I think it's a great recap of all of those things, and I very much appreciate your perspective on all of those issues. And it's going to be fun watching the world over the next few years with you tweeting about it.
Indeed, I appreciate you having me on. I've listened to probably half of all of these pods you put out, so it's been quite the honor to come on here and bounce some ideas back and forth with you. And yeah, it's going to be quite an exciting decade from here on.
We'll definitely have you on again, but you have to listen to the other half, okay?
Cheers.
All right. Have a good day.
Yeah.